trigger a more aggressive approach. It is a huge issue, especially given the economic dependence of the likes of Germany.
Two biggest geopolitical challenges of this world right now for the West, Tom, China and Russia.
Well, they're there.
Germany's the weak link.
John, in the last 15 minutes, markets really beginning to move. Dollar stronger for the first time in 3 days.
Yields up by 5 basis points, 325.28. Equities positive by about 0.5%. From New York City on TV and radio, this is Bloomberg Surveillance.
Almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dinings, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Hello traders again. It's time to move on and it's time to place order to 105.82.5. It will give us £500 in profit. Okay, please move your order to close, stop loss basically, yeah, to close your position if it will change direction to 105.82.5. Okay guys, stay safe. I'll speak to you later.
BSO season sponsor, Bank of America.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
I don't think we're turning a corner until the market knows that we have definitively avoided a recession.
The Fed has still a clear and present danger on inflation, and they've been behind the curve.
I think we might still see some upside surprises in inflation.
We're really trying to digest what the Federal Reserve is telling us.
The least resistance from here is still tighter financial conditions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up 0.6%. TK as G7 leaders confront very similar problems.
They're going to confront the markets as well. Just in the last 20 minutes, John, we've really started to see the markets, all sorts of little tweaks, little nudges, if you will, across the Bloomberg terminal, indicating a return to what we saw, John, 2 or 3 weeks ago. Those G7 leaders are going to return home to the same challenges: higher oil prices, stronger dollar.
Central bankers are confronting them, TK. We heard from President Lagarde a little bit earlier this morning. We'll hear from Chairman Powell.
Outline that.
Outline that.
You looked at that. I didn't look at that.
The speech is interesting, Tom.
Yeah.
Laying out what they've got to do and opening the door perhaps to a bigger move further down the road. And I think you're going to hear a lot more of that in the future, Lisa. They're set to go 25 basis points in July. The door's open to move away from that gradual policy stance and maybe go a little bit bigger further down the road.
Front loading is the word we're going to hear again and again, and we heard this again from Mary Daly, San Francisco Fed president, talking about how a 75 basis point rate hike is on the table next month for the Federal Reserve. They got it so wrong. And this, I think, is spooking everyone, that they misunderstood how sticky inflation would be. They don't want to let it get entrenched. They don't want to make another policy error.
Headline inflation for the Eurozone. Earning credit, I keep going to that report, looking for 8.6%. That's bang in line with America. The core picture, very different. Tom, a little bit earlier this morning, you referred to some people as monetary thugs. Do you want to give us a little bit more color on that and what you meant by that?
It's a punditry that's out there. I don't mean the leaders. I don't mean the central bank leaders. I mean the punditry. We're going to talk to people like Philip Hildenbrand, who we talked to 2-3 hours ago on Bloomberg, and Jean Boivin, absolutely first rate here in the coming moments. And John, that's the kind of people I want to listen to right now, not the parlor game about what the Fed's going to do 3 meetings out. We don't know what they're going to do.
Are you calling Lisa and I monetary thugs?
Yes, Lisa's.
That's what I thought.
Look, John,
that's what directly at me.
What is needed here, John, is not a mea culpa. What's needed is a Bramo culpa.
Okay.
What is a Bramo culpa?
About what?
A Bramo culpa is where you're just like you're worried about what you said, and you've got to reaffirm your negativity and your worry and gloom. And, you know, the Bramo gloom that's out there.
Gloomy.
That's a natural.
I'm neurotic. Yes,
neurotic,
I don't have to do that.
It's a Bramo culpa.
There's no mea culpa for Lisa this year, Tom. Best 6 months for her forecast of the last 10 years.
Yeah, the last 10 years before that, a nightmare. But, that's what he was implying, which is right.
Monetary thugs. Thank you, Tom.
Thanks.
Bitterly, John, bitterly of Citigroup yesterday was absolutely brilliant, folks. Here's the research from Citigroup. Listen, in the last 10 years, up 16% per year, and you're up only 9.7% if you take out the 10 best days in the last 10 years.
Kristen was wonderful.
Wow.
And if anyone's wondering why we're still in separate studios, I think maybe you can work that out for yourself.
I'm a thug.
And apparently I'm a thug too, and okay.
Just
Futures
stick
up
to
a
the
half of
100.
1%. I think you need a vacation, Tom, to be honest with you.
I need a vacation.
And that's that 100 up 0.4%.
I'm going south, 52nd Street.
Your equity market with a lift this morning, and good morning to you. Yields with a lift as well, up another 5 basis points. All of a sudden, looking at 325 again. 324.90 on a US 10-year. Crude positive 2 up 1.5% at 111.25 as we start to ease the quarantine restrictions in China. Lisa, about 2 years behind the rest of the world, seemingly.
Yeah, and whether this is actually some sort of relief from the zero COVID policy really remains to be seen. Janet Yellen coming out and saying oil, really the main driver of inflation. Well, it's not entirely the main driver. It's also housing prices. At 9 a.m., we get the S&P CoreLogic Case-Shiller 20-City Home Price Index. We have seen it rising at a record pace. Unbelievable to see a 20% increase in the price of a home. How much do we see that cooling off? And then how much does that feed into consumer confidence? At 10 a.m., we get the Conference Board's June consumer confidence reading. How much does this diverge from the University of Michigan Consumer Sentiment Survey, which has shown a record deterioration in how people are feeling? We haven't seen the same kind of negativity in the consumer confidence numbers, partly because it doesn't reflect as much some of the oil and gas costs that people are experiencing. How much does that divergence continue versus perhaps a little bit more convergence? At 1 p.m., I really am curious about this, John. The U.S. is planning to sell $40 billion of 7-year notes. We talked about the auction yesterday, the 5-year note auction. Did not go well. How much do investors boycott this particular auction of 7-year notes that are less liquid than 10-year notes? They have been trading with yields that are higher than 10-year notes for months now because of that lack of liquidity, because of that uncertainty over the longer-term horizon. John, which investors come to the table and see this as a good deal at a time of such uncertainty?
Lisa, you've done a tremendous job of explaining this over the last year or so. It's not just the 7-year, is it? It's the 20-year as well. The highest yield on the curve is not the 30-year, it's the 20-year at 362. What's going on with that maturity?
This has to do with liquidity, right? This is a relatively new reintroduction of a 10-year, and you don't have as big of a market and people trading within it. And it really highlights, John, the lack of liquidity that we keep hearing from investors that underpin some of the uncertainties, particularly with the direction of yields.
Lisa, thank you. Really important points. Let's get to Jean Bavin, the head of the BlackRock Investment Institute. They just had their Outlook Forum very, very recently. Jean, let's start with that. Your conclusions, sir, as you sit around the table with the team over at BlackRock.
Well, good to be with you this morning. Thanks. That was 2 days of pretty intense discussion. I think the key takeaway thing that came out clearly is we've been building up to that, but we are in a new regime. And I think the way we think about it now is, and Tom, I think will appreciate that. You go back to the mid-2000s, there was the debate about the Great Moderation, this remarkable feat where we had managed to decline the volatility of both inflation and output. We were debating why. Policymakers were taking credit for this, good policy being the reason. The alternative proposal, like Stuck and Watson at the time, were proposing that maybe it was just good luck. We'd been lucky. And I think now with 20 more years of experience in the last 2 years, I think good luck is a big part of the story. I think we are in a world now that is very different from the last 40 years. One that is going to be driven by supply a lot more, and that creates much sharper trade-offs. And we're going to see a pickup in macro volatility. We've seen that. I think this is real and persistent. And that leads to a much more complex world, which is not reflected in the narrative you're seeing out there. So I think that's the main key takeaway that we took away. And then from there, a lot of investment implications.
Well, let's talk about some of those investment implications, in particular, whether you also see peak yields given some of these supply constraints that could drive prices higher on a more persistent level.
Yeah, so I think we're gonna see. I think we're set up for a market to receive any incoming information on that is more inflationary very hawkishly. So that's going to be the bias. And then once we're going to see data that comes in and maybe gives some relief on inflation, I think we're going to look through this. So I think this bias is going to be with us for the next few months. I think that's going to be a bias that the central banks themselves will display. And so as a result, I think we're not at peak yield there. I think we're going to see front end of the curve continuing to be under pressure to go up, and recession risks continue to build up. So I think that's the story for the next few months until we see a bigger pivot for central banks, which we think will come, but it's going to be after some pain has been done.
So, Jean, with that backdrop, it sounds like you're probably in the camp of profit margin compression. It's not exactly a Goldilocks scenario for stocks either. So where's the haven if both bonds and stocks are potentially under pressure in this new volatility?
Yeah, just to pick up on one key point there, we don't see a Goldilocks on the table. That's what we mean by the Great Moderation is over. That period where we could hope to see both stability and inflation output eventually come to fruition. That was good, bullish for both bonds and equities. That's kind of over. No Goldilocks. So we need to be a lot more careful tactically. We're positioned very cautiously. Neutral on equities. We don't see the rally here as being something that you want to participate into at this juncture. And bonds will be government bonds will continue to be under pressure over the time to come, given what we just said. So a more cautious stance tactically. I think on the more longer-term horizon, we're going to see we don't see if there's a recession, it's not going to be a massive recession. I think we'll get to the point where we're going to be looking through this, and then equities from a longer-term perspective, I think, are a place to be if you can look beyond the one year and beyond. But until we get there, it's going to feel more painful in portfolios.
Hard to look beyond the next month or next week at the moment, Jean. Thank you, sir. As always, Jean Bavin of the BlackRock Investment Institute. TK, always depends on your time horizon, but at the moment, it's so difficult to just get out beyond the summer.
Let me explain this, John. It's really, really important. There was a fervent bout of literature in 2004 led by Olivier Blanchard and the great Jordi Galli, who wrote with Richard Clarida, and also some important work by Greg Mankiw, which pushed against the freshwater Marvin Goodfriend school and said there is a sacrifice to inflation stability. And the key question here for people like Boivin, who's absolutely first rate, easily could run the Bank of Canada someday. There's no question about that. John, the absolute critical distinction is when we get done with bringing inflation down to the easy level, say 5% or 4%, then what? And these guys are out front thinking about what happens when we get to just arbitrarily 5% inflation. That will be a huge deal, John, at Jackson Hole.
Tom, you're picking up on a really, really important point, but they don't want to talk about it, do they? Tolerating anything above 2.
No, the bankers, the central bankers do not. No, they can't. And to be fair, in the game, Jay Powell can't come out and say, look, politicians, calm down. We're going to go from 8%, 9% down to 5%, and then we take a victory lap. They can't do that.
What will they tolerate?
Adam Posen, I'm going to go there somewhat with Professor Blanchard talking about 3% as a new 2%. That's what I just said there. James Bullard would age.
Jackson Hole is going to be an interesting one. The end of August. We will be there. Tom Keane.
I
Lisa
love the
Abramowitz,
two-tone Tony
Jonathan
Llamas you
Ferro.
picked out, John. I think they look great.
Future's up a half of 1%. Are you styling, Gus? Is that what you're doing? Are you the new stylist?
He already bought me LL Bean.
I don't know.
What's he bought you?
LL Bean.
What is that?
We'll describe to you in the break.
Lisa.
Oh
Come
my
on.
God.
What is that?
Tom, what's going on?
It's just, it's
Okay. Futures are up. Good morning to you.
Put something in the tank.
This is
I
Bloomberg.
need something in the tank.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has made its biggest shift yet in its tough COVID zero policy. Quarantine times for inbound travelers has been reduced by half from 14 days to 7. That comes after Beijing and Shanghai said they had no new locally transmitted COVID infections for the first time since February. Runaway food inflation may be tamed soon, at least temporarily. Farm commodities have been falling after a surge that pushed up the price of everything from bread to chicken wings. The Bloomberg Agriculture Spot Sub-Index is on track for its biggest monthly drop since 2011. Fears of grain shortages is giving way to optimism that key producers will reap huge harvests. In San Antonio, Texas, 46 people were found dead in a semi-trailer, apparently the victims of heat strokes. Another 16 were taken to hospitals. Authorities suspect they were migrants. Texas has seen a surge in immigration over its border with Mexico in recent years. Smugglers sometimes use commercial trucks to bring over migrants. And last year, companies defied the coronavirus pandemic to go public at a record pace. Now market volatility, inflation, and fears of a downturn have brought an abrupt end to the listing party. According to data compiled by Bloomberg, companies have raised a combined $4.9 billion via U.S. initial public offerings this year. That's less than 6% of the record sum raised in the first half of 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
We expect to raise the key interest rates again in September, and I quote, if the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. If the inflation outlook does not improve, we will have sufficient information to move faster.
That was Christine Lagarde, the ECB president. That was a really important point in that speech a little bit earlier this morning from the ECB chief. You'll hear from her again tomorrow with Governor Bailey and Chairman Powell. Francine Lacqua, our very own, is going to guide you through the coverage in Sintra, Portugal, kind of like the ECB's version of Jackson Hole, Tom, over the last few years.
Yeah,
trying to ramp that up.
But not paper-driven. I sort of like it, to be honest, John. I think Sintra's a lot more about the debate of the moment with some real heavyweights, where Jackson Hole is really nerdy. I mean, there's a difference there, John.
Hearing from Emmanuel Macron right now, Tom.
Oh.
I think our audience will want to hear some of these headlines. Allies send weapons to Ukraine so they can defend, not attack. He does not favor listing Russia as a state sponsor of terror. Just a couple of the headlines there. On crude, he said this, and I think this is fairly obvious. The situation with oil prices is unsustainable. In the words of Emmanuel Macron just moments ago. He's speaking, Tom, right now.
Maybe this is before Ulysses S. Grant showed up for the American Civil War a few years ago, but it is a confusing set of messages. Amory Horton is in Germany on the G7 watch.
Okay, traders, as you can see, position closed on euro against United States dollar. Everybody who followed my trades, well done. You made a profit. This is how we trade on daily basis. You can see on the screen only 6 pairs, and this is what you can trade. We have several screens, so most of the market in the world, we try to trade on daily or hourly basis. If you want to find out and not only follow our trades, but to trade on your own without basically further kind of information, and you want to trust yourself, what you want to trade, get the strategy. If you'll get the strategy, you also can sign for the webinar, and you will find out how we make profit, how we trade, what we trade. We trade on margin. So in our case, we made right now £500. Not bad for what, about 1 hour work. I'll speak to you later, guys.
crime. It's a crime de guerre. He used that phrase. So there isn't ambiguity when it comes to that. It's just the issue about, does it get to a point where you arm Ukraine so much that Russia will say, you guys are now co-belligerent, so anything that's NATO, it's fair game?
Well, how close are we to that, Maria? I mean, I'm absolutely baffled by it's a war, it's not a war, attack, defend, all the rest of it. I think Americans' heads are spinning on this. How close are we to actually saying it's a war?
Well, I mean, Tom, there's no question that it is a war between Russia and Ukraine. The question is everyone else going to jump in it? And we've seen repeatedly that the United States says they won't fight boots on the ground in Ukraine. That was the signal that Vladimir Putin wanted to get also from the Americans. Are you ready to fight for Ukrainians? The answer is pretty obvious. They'll supply the weapons, but they're not going to fight for Ukrainians. For the Europeans is the same. And Emmanuel Macron also says there's a little bit of hypocrisy, irony in this, because every European country has agreed that they do not want to be co-belligerent in this. When you speak to some of the Eastern Europeans, however, countries like Poland, the Baltics, they already tell you, or they'll tell you, it only takes a second for this to escalate. But countries like Germany and the French are very scared of it. They don't want to be co-belligerents here. They want to help Ukraine, but not fight the war themselves.
Anne-Marie, one thing they're exploring now is a cap on the price of Russian crude. Now, this is pretty interesting because tomorrow, in the next couple of days, we'll hear from NATO leaders who are set to criticize China. And at the same time, it's very difficult to see how a cap on Russian crude prices will work without the participation of China. So AMH, walk me through it. How is this going to work?
Well, again, this is just an idea, and they've agreed to continue discussions of idea. There's no set price on what the cap would be. There's no set timeline on when they would implement it and how the mechanism in actuality would work. And Jonathan, you bring up a really good point, and there's two. One, China and India, which is bringing in a lot of Russian crude at the moment for a very cheap discount, would have to sign on to this. The second part, of course, is that Russia would have to sign on to it. They'd have to say that they'd be willing to take that cut, and which the West wants to be very much closer to how much it costs for them to produce it. A lot of moving parts in here, and it means that the West would have to get China on board for this. We do know from Jake Sullivan, he had said on Monday to reporters that in the next few weeks, potentially we'll have this phone call, a conversation between President Biden and Xi Jinping. But if I could just say one other point about NATO, how they're going to call out China. Can you believe where we are now? In 2010, when they came out with this document that guides them for the next decade, and now this document will guide them for another 10 years, China wasn't even mentioned, and Russia was called a partner.
Right.
It's a complete 180 at NATO in Madrid.
So, Anne-Marie, building on this idea of how do you enforce some of these caps or measures with Russia and China, Olaf Scholz coming out this morning and saying that he expects China not to undermine Russian sanctions. How difficult is it to even determine what that means, given some of the vagaries here and the lack of cohesion on even just buying Russian oil?
I mean, it's going to be very difficult because, again, China has this unity forever with Russia. Remember, they have this new strategic statement that came out at the start of the year. And, of course, we have Chinese officials who really have not condemned the war at all. They are leaning more into that support of President Putin. But we should also note a cap for China and India would be very helpful. That would be very much so cheap oil from Russia. But at the same time, if it is going to undermine President Putin, that can affect other parts of Beijing and New Delhi's relationship with Russia, it's going to be very hard to get that on board. Never mind the fact that they need to get insurance companies, shipping companies, and the finances on board for this. This kind of mechanism, which I know the United States is very much so for, when you look at Russian natural gas going into Europe, Premier Mario Draghi is very much so for. But how in actuality does a mechanism like this get translated to the market? Incredibly difficult. And also, speaking of French President Emmanuel Macron, he doesn't want to stop at Russian crude. He's calling for caps on oil worldwide. Try to get the Gulf on board with that.
Are you heading to Madrid after this?
I'm going to stay for one more hit with you, Jonathan. I'm going to do it on the road on the way. But yeah, I'm going to be joining Maria. We have some tapas planned.
I'm sure
Maybe
you do.
Some Real
That's what I
Madrid
was
talk.
trying to get into. I was just wondering what was going on here with Maria Tadeo and AMH and in Madrid together, Tom. Trouble. Trouble. I think there's going to be trouble.
I'm looking to go south this weekend. I'm
We have
trying
a
to get
whole
down
Friday
to
night
52nd
plan.
Street.
I know you do. I'm just trying to tease some of that out onto the show.
No, you're trying to wind up Tom and tell us why can't he go on a road trip?
I think there's going to be a particular nightclub on Friday in Madrid that's hosting Maria and Anne-Marie.
Oh, yeah?
That I'm just trying to get them to reveal slowly through the next couple of days. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Live from New York City this morning. Good morning to you all on TV and radio. Here's your rally, if you can call it that, up 0.6% on the S&P. On the Nasdaq, we're up by 0.7%. We've had a cut from Citigroup in the last 12 hours. They've gone from 4,700 down to 42. They think the second half, though, there could be a rally in store. They think the risk reward is better. They think earnings will be better than feared. They're not alone. JP Morgan, Marko Kolanovic expect maybe in some parts of this market to recover all the losses in the second half from the first half because expectations are just so bad. Then you fold in the view of Lisa Shannon at Morgan Stanley, who says Where are those weak expectations? Because at the company level, the analysts haven't started downgrading earnings yet in a material way. So things pretty divided on Wall Street, as they always are. But Tom, I think that's counter to this view that everything is very gloomy, because there are still some people out there that are very constructive on this equity market into the second half.
Well, I thank our team for booking optimists here, John. I think there's many more optimists out there than sort of the aura, particularly the weekend gloom, John. As you get to Thursday and Friday out on the internet, there's a lot of world coming to an end out there, and there's a whole bunch of people pushing against that. And I'm going to go back to my core theme, John, which is corporations will adapt, as we saw from Federal Express 6-7 days ago.
It will come down to corporate earnings, Tom, and you're right. If there is a fear out there right now, there is the fear that that is the next shoe to drop, and we'll be on top of that story. I think July 14th is when things kick off with JP Morgan. So
is it that soon?
In a couple of weeks' time, Tom. Let's look at the bond market just quickly. June 14th, just short of 350 on a 10-year. We backed away. Now we're backing up again on a 10-year by 4 basis points to just short of 325. Let's call it 324. This gets more interesting tomorrow. We hear from Chairman Powell on Friday, ISM manufacturing. For the ECB, we've already heard from President Lagarde. You'll hear from her again tomorrow. For euro dollar, it's going to be about inflation at the end of this week. Inflation coming up on Friday, and it could come in and around 8.5%. That's the median estimate in our survey so far. UniCredit going for 8.6%. Right now, Tom, euro dollar 105.81, off the weakest point of the year, which had a 103 handle, but still pinned down at these kind of levels. You can still try and work out what's in store for the Eurozone through the rest of this year.
Yeah, I'd watch dollar yen as well, John. 136.71 is the daily high there. We're nowhere near that, but nevertheless, to get a 137 print, weaker yen would be a surprise for the week. We're not there yet.
Lisa, things to say about auctions later?
They're happening,
They're
and
happening.
I'm looking for them. I honestly want to see how much demand there is, especially overseas, especially because some of the peak inflation ideas are getting challenged by that number that we're going to get on Friday in the Euro region and beyond.
Tom, you excited for that?
I'm edge of my seat.
I can tell.
There's the auction.
You think it's valid, right, John?
I think it's valid. I just think it's entertaining that you spend every single show trying to convince Tom that it's important, and he's still not on board. That's some of your cross-asset price action. Let's get some single names. We can do that with Romain. Good morning, Romain.
Hey, good morning, John. Well, here's something that's important, and of course, all eyes on China right now, and all the major movers here in the pre-market, at least to the upside, seem to have a link now to what we're hearing over there, the first major loosening of those COVID-related quarantine restrictions. So most of the big gainers that you're seeing in the pre-market in the U.S. are those travel stocks that would benefit most from that easing. A lot of the casino stocks, including Las Vegas Sands, Wynn, and Melco, the companies that have a big presence in Macau, all rallying here on the day. Las Vegas Sands up about 7% here in the pre-market. U.S. airlines like United and American also higher, as are a lot of the cruise lines. And Trip.com up about 16%. Obviously, this is a travel company based in China, and its primary customers are outbound China travelers. They're seeing a nice boost from this as well. So keep an eye on a lot of the travel stocks as well. But also keep an eye on Nike. It was interesting. They came out with earnings last night, and those shares are down by about 2% here in the pre-market. They said their China business is not doing well at all, down about 20% on a year-over-year basis. And they said that basically about 60% of their China business had been affected by the COVID shutdowns, and then it could take as much as 3 weeks to get everything back up and running to normal. That's when all of the restrictions are actually eased. Nike did also address the issue that there's been a sort of growing swell of nationalism that has actually shifted a lot of consumers away from Nike and to more Chinese-made brands. So something to keep an eye on there. You flip it up, we want to stay on the China theme. Second biggest volume mover this morning actually is a company called Playtika. It's a gaming company. We're learning that Joffrey Capital is going to take a major stake in this company from its Chinese owner. So this is a big deal, kind of a shift in the majority ownership, I should say. The share is higher here in the pre-market by about 5%. The biggest volume mover out here in the U.S., though, is Robinhood. Robinhood shares down about 3.5% in the pre-market. They rallied 14% yesterday on the back of that Bloomberg scoop that Sam Bankman-Fried's FTX crypto exchange was potentially looking into the idea of buying Robinhood. Sam Bankman-Fried later came out with a statement that he emailed to Bloomberg saying that there is no active M&A discussions, though he didn't necessarily address the substance of the Bloomberg article, which is whether he was actually interested in it at all. So these shares have been oscillating all around as a lot of people try to figure out what he's going to do. And of course, we got the results of those bank stress tests from the Fed last week. Last night, of course, we got the announcements about the dividend buybacks and shareholder returns. Morgan Stanley, Goldman Sachs boosting their dividends, and and buybacks, while JP Morgan and Citigroup standing pat, though all of those names are higher in the pre-market. Morgan Stanley, Tom, up 3%.
Romain, thank you so much. To close this afternoon, right now, an incredibly important conversation. Gregory Peters joins us. He's co-chief investment officer at PGIM Fixed Income, but someone with decades of perspective from Morgan Stanley to PGIM of the ups and downs of the golden age of fixed income. Greg, thank you for joining. As a blended idea, we're down 12% on price on bonds. You write of a golden age and saying it's over. Can we get a Hail Mary for the bond market like we did from 47, 48 out to the Eisenhower disinflation 4 and 5 years later, where it's big price up, yield down?
So I still think we have a little ways to go on this one, honestly, as there's all this talk around peak inflation and peak hawkishness. And I think those two terms are being conflated in here. As you can have this peak inflation and then not go peak hawkishness. And what I mean by that is that there's all this sensitivity in the market where inflation is going to ultimately show signs of coming down. And that means the bull market begins for bonds, which means the Fed doesn't have to tighten as much. What I think is missing there is the persistent nature of inflation that might actually cause the Fed to actually hike even more than anticipated.
Greg, let's dig into that a little bit. In other words, you think that people are underestimating how sticky this inflation is and how committed the Fed really is to not getting the inflation rate down to 3%, as Adam Posen says, but down to 2% in short order.
Yeah, so I'm not sure of where inflation will land ultimately. I think that's the challenge, that's the difficulty. But I'm pretty sure that the Fed is extremely focused on inflation. And I think that's what investors have missed this entire period, which this is a Volcker-esque type of Fed where they are clearly focused on getting inflation down. And they are not going to throw away 40 years of credibility, which we know actually matters a lot over the medium to long term. They're not going to throw that credibility away just because the markets are telling them to.
So, Greg, just to take that a step further, does that mean this Fed won't tolerate an easing of financial conditions anytime soon? And what does that mean for how you put money to work?
Well, so I think somewhat perversely, the financial condition picture has been much stronger than I think the Fed anticipated. So I think financial conditions have to worsen. I think that's the natural path here. Yes, you've had really big moves thus far. I understand that there's more value in the market today than there was, 6 months ago. Absolutely. But for example, we just had this internal poll that we conducted with over 300 of our investment professionals, and 76% of those folks believe that we'll have a hard landing. And in Europe, it's almost 90% believe there's a hard landing. So the point being that there's still a lot of risk out there on this hard landing camp.
I just want to pick up on that line, Greg. Financial conditions have to worsen. Can you give me an idea of what that would look like and where to look for it?
Well, so I think it's the natural items of stocks. I do believe risk assets have to cheapen up more. I know the focus is on earnings. That should be the focus. But we're coming off this margin type of environment. All this operating leverage embedded in these capital structures, that cuts both ways. So if you actually see a slowdown in revenues, that's going to have the opposite benefit that we saw coming out of the pandemic. So I worry about risk assets, both equities and credit in here. I think there's more room to go. With such a high probability, I think at least, a high probability of a hard landing, I'm not convinced we're priced for that in a scenario-based way.
So how much cash are you carrying at the moment, Greg? Just give me a picture of what you've been doing, what your picture looks like going into the end of this year.
Yeah, so for us, it's not so much about cash. We have increased our cash levels on the margin. It's more around the liquidity in the market, which is something that should be focused on as well. So you're seeing liquidity in fixed income, which is always fraught, but much more kind of volatile liquidity picture. So we're getting more defensive. We have been getting more defensive. We have taken our long duration investment grade corporates down. We continue to move our high yield exposure down. We've been decidedly kind of muted and underweight on emerging markets, and we are, quote unquote, hiding out in a short duration spread product and structured products. But I think the ultimate trade here, the sequencing of the trade is long duration before you're long risk assets. And so the volatility makes it really difficult to pick your points. But to me, the duration trade is going to be the best trade here.
Greg, fascinating stuff, as always, buddy. Thanks for being with us. Greg Peters there of PGIM Fixed Income. Lisa, if there's a headline there, it's a pretty obvious one. The team at PGIM think financial conditions have to worsen.
Yeah, and that they're trying to get liquidity so that they can get ahead of that, and that when they do go back into risk, it's going to start with duration. It's not going to start with the idea that the companies are getting into a better situation.
Coming up in the next hour, Mike Ferroli of JP Morgan, the chief US economist, going into an important week for US data, and to hear from Chairman Powell once again. Futures up 0.6 to 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A Russian missile attack on a shopping mall in central Ukraine has killed at least 18. Authorities say dozens more were wounded and more than 30 are still missing. A group of 7 leaders meeting in Germany called the attack a war crime. In California, the state Senate has passed legislation that would allow the public to sue firearm manufacturers for harm caused by guns. The bill is designed to use industry standards to permit lawsuits, despite federal law which immunizes gun makers and dealers from civil liability. It's part of a package targeting gun violence that California Governor Gavin Newsom has promised to sign. NATO is set to label China a systemic challenge when it outlines its new policy guidelines this week. Bloomberg has also learned that the US-led alliance will highlight Beijing's deepening partnership with Russia. Still, NATO won't go so far as to call China an adversary. And British socialite Ghislaine Maxwell finds out today if she will spend the rest of her life in prison. In Manhattan, a federal judge will sentence Maxwell on charges that she engaged in a scheme to lure and groom young girls for sexual abuse by former boyfriend Jeffrey Epstein. Prosecutors want a sentence of 30 to 55 years. Credit Suisse is seeking to emerge from 2 years of scandal and losses. The Swiss bank is promising to boost its business with rich clients and cut costs by simplifying technology. Credit Suisse plans to grow its wealth management unit by focusing on priority markets such as Hong Kong and Singapore. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question.
Great question.
Great question. Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I do believe we have reached peak inflation. Inflation will start to come down as financial conditions tighten, as central banks normalize rates. But we're not going to get to 2% without significant damage.
Hildebrand there. Philip Hildebrand, the BlackRock vice chairman, on peak inflation. I have to admit, year over year, I thought we'd done that a few months ago, and then we got last month's print, didn't we? So look out for that. Futures on the S&P up 0.6%. On the Nasdaq up by 0.5%. Yields on a 10-year up 4 basis points, 323.95. And my inbox full of emails about Al Bean because of Lisa's mention of it a little bit earlier this morning. Camping and hiking gear at Al Bean.
What'd you expect?
I had no idea what it was. It sounded like coffee.
It's a really good cup of LL Bean. Honestly, I think that it's important. We should all be outfitted in, in camping gear.
Camping gear in Jackson Hole. TK can't wait.
We
can't
stop
wait
the show right now.
Awesome.
To inform the lad of LL Bean. You go up to Freeport, Maine, John. The store's open 24 hours a day, 365 days a year. And long ago and far away, you had not 1, 2, 3. You had 3 set of some form of LL Bean boots in your college closet. And John, I just think it screams, John. Lisa, help me out here. I mean, Pharaoh's got to wear the 16-inch LL Bean classic boots. I mean,
they're expensive, Tom.
Well, they'll keep the snake bites away.
Yeah,
I was just looking at this Sunbuster folding shelter for $139.
Yeah, there you go.
Yeah, this is the amazing thing about US broadcasting, Tom. You couldn't do this in the UK without saying there are other good stores to find your camping and shelter.
Oh, really?
Goods from.
There's only one LL Bean. Leon Wood Bean, 1912. And that's enough of an ad campaign for LL.
There we go. We're done.
Today. We'll get John. We'll get the blanket, the Hudson Bay kind of LL Bean.
Awesome.
We're done except for
Pretty Goop is going in Texas. We don't wear LL Bean. She joins us right now on retail. And this is on a sneaker company.
It's on a sneakers company. And I should say we don't wear boots in Texas, but we do in Virginia, where I got a very
rude awakening about how cold it can get in the Northeast. And of course, LL Bean very coming in handy. Also coming in handy is Nike, and this is important when you talk about their earnings picture because, of course, we know the stocks across the board have taken quite a beating. But Nike's interesting in that it's taken a little bit of an extra beating, and a lot of that has to do with the China question, their China exposure really coming front and center in their earnings that they reported today, once again saying that their sales from China dropped about 20% in the last quarter. They're worried about the macro risk going forward. It's actually weighing on their entire full year forecast, and you can see where that's been reflected in the shares. To our radio audience, what you're looking at here for the chart of the day is Nike shares relative to the S&P 500. When the line goes up, Nike is outperforming the S&P 500. When the line goes down, it's underperforming, and so far it has been underperforming the index year to date, and a lot of that is because of that Chinese exposure. If you go across the index to other companies, Starbucks, McDonald's, that have similar kind of exposure to China, you'll see the same dynamic.
Critty, thank you so much. Greatly appreciate it. On retail, and particularly after what Goldman Sachs wrought over the last 2-3 days, John, help me here. Mr. Constant out with a note of gloom a couple days ago, and it's sell-side retail following on. I mean, there's no other way to put it,
It's
right?
sort of a load of price target cuts from Goldman across a range of retailers yesterday, Tom. I think it was Walmart, Target, Restoration Hardware, take your pick.
We don't do buy, hold, sell at Bloomberg Intelligence. That's what we're acclaimed for. Poonam Goyal joins us now, not on the buy, the hold, the sell, but on the reality. And the reality, Poonam, is the inventory of Nike is up some 23%. Where do you put all those sneakers? I mean, do they have warehouses to the brim? Are they taking Amazon warehouses and using them to store Michael Jordan sneakers that John wears every weekend?
I don't think they have a warehousing problem with the sneakers. They don't take up that much room. I think, though, the inventory is definitely higher than we would have expected because they didn't want to run out of sneakers, right, through the pandemic when they were having more severe supply chain hiccups. I'd be more concerned if the inventory was elevated on the apparel side than footwear. So if they have more footwear than apparel, I think the demand there is very, very strong. On the apparel inventory that's been overbuilt, that's where I'm a little more concerned because we do have continued weakness in China. And we also have sales slowing in North America. North America sales, which is their largest market, 40% of revenues, was down 5% in the quarter and missed consensus estimates.
Poonam, how much have we priced in the margin compression that we're expecting to see? I mean, I'm looking at the retailer index, the sub-index of the S&P, down nearly 30% so far this year. How much more do we have to go, given some of the uncertainty, the gloom that Goldman Sachs was highlighting, and the fact that they're dealing with margin compression, not just because of supply chain disruptions, but a more discretionary consumer?
Yeah, I think we could have some severe margin compression in the second half. I mean, if you think about the inventory that's coming on board from the supply chain hiccups of the boats finally coming to the ports and into stores and warehouses, the consumer demand for now is still pretty strong, but as inflation builds, as consumers begin to pull back spending, as they see their pocketbooks and balance sheets shrink, you could have more inventory than what you're even contemplating today. And that's when you'll hit the vicious cycle of promotions across the board, and margins could be subject to further pressure. Also, remember, the second half is the largest part of the year. It's back to school and holidays.
Right. Poonam, how do you clear inventory? Is it just price? You just mark it down and out it goes?
That is the only way to clear inventory. You can liquidate it. You can mark it down. You can't burn it. That's not sustainable anymore.
Helpful if you can move it too, Tom. And at the moment, a lot of this is all backed up. Big transit problems. Poonam, thank you.
I agree.
Huge transit problems.
Yeah,
Poonam Gaur there.
I agree.
Of Bloomberg. And Tom, I go a step further. Just for Nike, a bright spot. Direct to consumer has been really, really good.
Well, and
really good results there.
I don't really understand why that's not just going to continue to get stronger and stronger. Direct to consumer to me is the future. Maybe I'm wrong in that. I would point out, John, the Air Jordan 1 lows, they come in AC Milan colors.
Do they,
I mean,
Tom?
they're perfect for you.
I'm not sure that's quite my style. I can tell you that Bramo's getting hammered, though, on that front. Because one of her youngest
You're just tweaking
quite
me.
likes those.
Yeah, well, he's into the whole resale market, and he's really
So he
excited.
buys them and then
he buys them and then he resells
He wants
them.
to do that, and so he'll, work on making sure that they don't get any creases and walk like, he has wooden
So
legs.
he will wear them?
Occasionally, and then he feels guilty.
And then he
I don't
tries
need
to
to go
sell
into
them.
this. Yeah, exactly.
No, I'm trying to work out what's the business model there.
There's
How much
a
do they
whole-
make? What's the markup?
There's a very big markup, and if you get a rare one, then it's an
Well,
even
can
bigger
you,
markup.
Lisa, can you get day trade to go into a pair of LL Bean boots? I mean, did you see him doing that?
You know, I think we're moving away from that right now, and I think that we're going to try to shift into other interests.
What like?
We could discuss that in the break.
No, I'm just interested.
No,
Because I wanted him to day trade.
I know.
You guys ago.
You guys want him to day trade, and at the same time, when your kid is walking like he's got wooden peg legs, so he doesn't get creases in, and is figuring out how to iron with a wet cloth in order to get the creases out. I mean, I guess it's taking care of things. It's good. It's good.
This is good. It's all good, John.
Is this good? Is this fascinating? Is this riveting?
This was a better than good segment.
When do they go back to school? That's what she's asking.
Yeah, pretty much.
You don't get to take you back on live TV and radio, Lisa. Up 5 or 6/10% on the S&P this morning. On the Nasdaq 100, up 0.5%. Yields a little bit higher, up 4 basis points to 323.76. China easing some quarantine rules for travel. I'm not sure how material that is, but crude apparently likes some of that. Up 1.5% on WTI, 111.23 with Tom Keane, Lisa Abramowitz, who's broke for the rest of the summer. I'm Jonathan Ferro. For our audience worldwide, this is Bloomberg Surveillance.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
every single major spike in inflation has been fixed with the recession. The question is it a big R or a small R?
If that stimulus is lacking in this economy, anticipate a slower growth backdrop.
As we go forward with more rate hikes and continued high inflation, it's going to slow. The question is, how much does it slow?
All inflation is the same at this moment for the Fed.
The bottom line for this rally that we're seeing is, unfortunately, I think we're going to see continued volatility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for joining us on Bloomberg Radio and Bloomberg Television. All that's going on in Bavaria, in Madrid, the economic data, the market up 23 points. Guess what, John? Housing, Case-Shiller, up 21% year over year. Is that the greatest distortion that we look at?
How much damage do we need to do to get inflation back down? That's the number one question right now, Tom. With these central bankers absolutely determined to carry on doing what they've been doing, including Chairman Powell, President Lagarde set to jump into the mix, Governor Bailey, you'll hear from him tomorrow too. What we heard in the last hour from Greg Peters at PGIM, I thought was just fascinating, Tom. His view, financial conditions need to worsen. They need to worsen because this central bank can't tolerate an easing of financial conditions when they are so determined to get inflation down.
We'll hear some real caution from Alicia Levine here in a moment. John, I want to go back to Philip Hildenbrand earlier on Bloomberg, Jean Boivin, BlackRock, who he spoke to. And it's in the Lagarde comments that you mentioned today with Francine Lacroix in Portugal. And John, to me, it is this gravity of what do we need to do to wash out the huge fiscal stimulus, and the answer, conversation after conversation, is more pain.
Go a step further, Tom. I think you're asking a more important question alongside that as well. Will they tolerate a higher level of inflation so they don't have to inflict so much pain on this economy? They're not going to share that with us now. That's part of the guesswork, I think, for the back end of this year into the next year. How much inflation will they be willing to tolerate?
Right.
And what does that mean for your call in this market?
Lisa, do we see any crack in home prices? I guess I get a little bit of anecdote, including mortgages near 6%. But I'm sorry, we're so taken by all these details, we don't see housing up 21%.
This goes to the underlying fundamentals of this market. We are not looking at a 2006 style housing market where there was a lot of leverage, fueling, flipping, and all sorts of speculative activity. These are home buyers who want to live in homes and who have cash to put down and are not overly leveraged. That said, Tom, the bigger question in my mind is how long will it take before you see some sort of slowdown in the housing market before that trickles out into rents, which are still climbing at a record pace?
And the market here, we're going to do a data check here. John, I'm just going to look at the good feeling of equities over the last 4, 5, 6 days while you were on sabbatical, from 32 to a 26 handle, 26.97 on the VIX.
Can a man not go on vacation anymore?
It's a sabbatical.
It's a vacation.
Halls. What? Halls. In England, you go on halls.
I'm just beaten down. I'm so upset. Futures up 0.5 on the S&P. On the Nasdaq, up 0.5%.
Lisa's going on halls.
Yields up 4 basis points. Holes, Tom. Never called it holes?
No.
I use the word vacation and my family berates me for that now.
Seriously?
It's a holiday, John. Don't change. 324 on 10s, Tom.
That is funny.
In the commodity market, 111. If I say holiday here, no one understands me. It's like pavement versus sidewalk.
We're not that dense.
You're a very confused lot.
Oh, come on.
Very confused.
It's ridiculous.
Eyeglasses.
Can you imagine me on a 2-week
glasses.
vacation?
It's ridiculous.
Waste paper basket.
John, what would I do? What would I
know?
do on a 2-week vacation?
What would you do, Tom?
Given
how this show's gone over the last couple of hours, it feels a bit like a vacation, Tom.
You know,
To who?
I don't know. John, Brent crude, let's talk about it. 117.35. I'm sorry, there's a lift, 6.5% in oil.
Yeah, China easing quarantine rules.
Yeah.
I think there's this belief that that's the direction of travel and things ease up from here even more and that Chinese demand picks up. Who was it, Jeff Yu of BNY Mellon, that wrote into this show yesterday and talked about the lack of an impulse from China on the inflationary story of the last 6 months?
Right.
Maybe that could kick in the back half of this year.
The demand that a lot of people are talking about across the Pacific Rim. Right now, and this is an important conversation. She's head of equities capital market advisory at BNY Mellon Wealth Management. Alicia Levine, always on the edge of enthusiasm. And I'm sorry, Alicia, buried in your note is the outlier what if, which is a multiple for the market out of another time and place. Can you actually multiple a gloom 12 times multiple on the market?
That would be our extreme left tail risk, but it is out there as a very low risk scenario when it goes something like this. And it's similar to the conversation you've been having this morning, which is that, earnings for the second quarter are expected to be up about 4.5%. But for the second half of the year, earnings are still up on expectations 10.5%. The second half, which I think is probably not believable. We expect margins must come down here, and the way that stimulus, increased the revenue side, it also increased the operating margin side. We're at record margins. That has to come down. So as earnings come down, the multiple will start looking higher if the market just stays where it is. And in a recessionary scenario, you could be down on earnings 10 to 30%, and with that, the multiple goes with it. So I would say an average recession multiple is 14 times. Whatever those new earnings are, expect it to come down 7 to 10% from here. And then you put the average recession 14 times, you're about 3,400, about. As a first stop before we can think about moving higher here. So we're in the chart. I think the rally in the last week or so is an expectation that PCE data that we're getting on Thursday is going to show some peak inflation. But once we've rallied 6 or 7 or even 10% into it, then where do you go, even if it is slightly peaky?
Alicia, that scenario you just painted, is that just a bearish scenario, or is that your base case?
That is not our base case. That is a bearish scenario. But you have to start thinking about, well, if the worst case happens, where does it go? We actually think there's a 50-50 chance of recession in the next 12 months. So there's that bumpy landing, not really a soft one, but a bumpy landing, about 50% recession on the other side of that. But we do think the recession will be mild, meaning the job market is so strong and activity is pretty strong in the economy. We don't think we'll see anything deeper. The wild card, of course, is if there's some kind of contagion in financial markets. So if we get a market dislocation event, of course, that could make it worse. But right now, we're seeing this as a slowdown, an earnings slowdown, a mild recession, and then something we can build out of here. But I agree with your previous guest that tightening financial conditions is part of the Fed's solution to the inflation problem, which means, of course, the market will go lower as part of the plan.
So which equities do you see as probably bearing the brunt of the pain? And I'm thinking in particular of Goldman's call on retailers that are facing perhaps extreme margin pressure in the face of inventories and other factors that are much more volatile.
Look, on the consumption side, on the consumer side, it's all about the inventory to sales ratio. If you think sales are moving lower, and we know the inventory levels are up 30 to 50%. So the margins are going to come down pretty quickly, and it'll hit earnings pretty quickly. So I would say that's pretty much ground zero for where we see earnings revisions right here on that discretionary side. The stocks are acting like it. If you look at the staples versus discretionary, you can see the vast outperformance on the staples side. So that's where you should see the multiple compression and the earnings compression first. And you'll see it in the second quarter earnings as well.
Alicia, have we already reached the point at which it's time to start selling out of the energy positions? The idea that we've already seen that wager kind of roll over, and now people are more worried about recession and lack of demand. And so too, will the stocks reflect that?
So that's a great question. I mean, it's something we have to think about. We are bullish on energy stocks with WTI staying above 95. So on a technical level, over 95 means the energy stocks should probably still work here. We do think there's a structural issue. There's some cyclical component in the movement on the energy sector, but it's more structural. And as you've pointed out, energy's managed to move this high with China, with 1/3 of Chinese locked down. So to the extent that there's any demand from China coming out of a COVID lockdown situation, it should help support energy prices and therefore the stocks. You're probably not going to get that parabolic move. You know, we always talk about how parabolas don't make great technical charts, but we think it's too early to sell out here.
Alicia Levine of BNY Mellon. Alicia, thank you. Some pain in some of those names last week. They bounced back just yesterday. I think the oil trade, the energy trade is so tricky into the back half. If you look at the Federal Reserve right now, they're targeting inflation expectations. And as we know, Tom, inflation expectations are heavily influenced by what happens with energy. So ultimately, if you take that a couple of steps further, can you make the assessment that this Fed is targeting energy and demand destruction, I don't think you have to go that far to make that assessment. Do you conclude that they can achieve that?
PCE deflator, 6.4% survey. PCE core deflator, John, 4.8% survey. The suits and ties and the fancy dresses are taking out the agony people are facing. This is serious stuff, John. There's some real agony out there when you look particularly at rental data and eviction data. This is really serious. And yet, Bloomberg-type people wean it down to a 4% statistic, which seems palatable. It's not.
Lisa, you don't have to look too far to find that pain, that's for sure.
No, and that's the reason why I think that the retailers are so interesting, particularly the Walmarts and the Targets, because there are people who are making decisions based on how high gas prices are, what else they can afford, whether they're going to go out and make those extra, clothing options available to themselves. Honestly, these are all of the things that'll give tea leaves into where the trajectory of this economy is going and how much pain is being felt.
It's a big part of this program through the year so far. Will continue to be through the rest of this year, I imagine. I fear that perhaps it's a story going into next year. For many people, let's hope that's not the case. China's been a big part of the story this morning, that's for sure. We'll catch up with Leland Miller, the CEO of China Beige Book International, in just a moment. Futures up 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A group of 7 nations have agreed to stick by Ukraine to the bitter end. At the same time, they pledged to ratchet up the cost to Russia of its aggression. Still, they left much of the detail of how to do so unresolved at the conclusion of their summit in Germany. Leaders also told China to, quote, abstain from threats, coercion, intimidation measures, or use of force. And China has made the biggest shift yet in its tough COVID-0 policy. Quarantine times for inbound travelers has been reduced by half, from 14 days to 7. That comes after Beijing and Shanghai said they had no new locally transmitted COVID infections for the first time since February. The SEC has fined Ernst & Young $100 million in a cheating scandal involving the ethics portion of the Certified Public Accountant exam. The agency also said the firm misled U.S. regulators probing the misconduct. It's the largest ever penalty for an audit firm. And last year, companies defied the coronavirus pandemic to go public at a record pace. Now market volatility, inflation, and fears of a downturn have brought an abrupt end to the listing party. According to data compiled by Bloomberg, companies have raised a combined $4.9 billion via U.S. IPOs this year. That is less than 6% of that record sum raised in the first half of 2021. And Walgreens Boots Alliance says it has decided to keep its Boots and number 7 company businesses under its existing ownership. Boots is the largest drugstore chain in the UK, according to Sky News. The reason is conditions in the debt markets that were hampering bidders' ability to make firm offers for Boots. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Boston Pops Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fife and Drum and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
As you're seeing central banks across the world hike rates to slow their economy down, because of China's experiences with zero COVID and a much slower economic momentum, they're actually lowering rates. And that means that the carry advantage or the yield advantage that used to be in the case of the CNY relative to other currencies is just no longer there. And so China's in a very different place.
Kalakshir Trivedi there of Goldman Sachs weighing in on China just yesterday. China, a big part of the story this morning. Good morning to you. Equity futures up 0.5%. We all woke up a little bit earlier this morning on the East Coast to news out of China that they were easing the quarantine for travel. Does that open up a better demand picture coming out of the world's second largest economy? We can talk about that in a moment. Yields higher by 3 basis points, 323 on 10s. Crude up by 1.5%, Tom. 111.20 on WTI.
You know, the movement here in the market, I'm going to call it sustained, John. I mean, the fact is, we gave way yesterday. What did we ever understand why we gave way yesterday?
Sometimes you can't explain every single tick, Tom.
Exactly.
Some data. There was at Dallas Fed yesterday. Some of the data points haven't been great.
Yeah, I don't.
PMIs last week, ISM on Friday.
I got some dollars stronger. I'm watching yen. It really hasn't moved. But again, and maybe as Alicia Levine said, folks, we're just focused on PCE a couple days away. Right now on China, an incredibly important conversation. Please take notes. Leland Miller with us. Chief Executive Officer, China Beige Book International, and really wonderful granular data about China. Shanghai, 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 Shanghai. Leland, I'm worn out by it. If I get on the bullet train, as I have, and I go out of Shanghai, I go west to 5 million people, and I'm going to butcher the name, Changzhou, which is an industrial town west of Shanghai. How is COVID in the places we're not focused on?
Well, I actually think that's the biggest story of the second quarter. Now, we can talk about how things will get better now that lockdowns are easing and travel quarantines are easing, and that certainly will happen going forward. But the biggest thing about the lockdowns was not that Shanghai was shut down or that a couple other big cities were shut down. It's that the secondary effects were much more significant. That was reflected in the current conversation, certainly most data. So, the second quarter numbers are actually much worse because of what was happening in April and May and the secondary effects of those lockdowns than people have been admitting. So things will be improving, but you got to improving off what? It was a lot worse than people were acknowledging, than the government was acknowledging just weeks and months ago.
And translate that, Leland, into the economic backdrop. I know you do a lot of granular data, taking a look at the on-the-ground picture. What are you looking at in terms of GDP growth in the second quarter, in terms of a full-year expectation on the backs of that worse-than-expected data?
Well, based on the weakness that we saw in April and May, the second quarter's numbers should contract. They will never announce a second quarter contraction. Li Keqiang made that very, very clear in May when he said that they had an all hands on deck effort to boost growth. They needed to get stable growth. And some senior finance officials came out a few days ago and said, we will see reasonable growth for the second quarter, which means positive growth. So I think, we have an internal bet. Our chief economist and I have an internal bet on what they're going to hit. My number was closer to 1.8. Our chief economist number was a little above 2. So we think they're going to just throw this number on. It's not justified by the data, but I think that people are embracing this idea of a June comeback, a June bounce back, which was not in the data, but they're embracing this narrative, and so they will accept a number in the 2% range, which markets will get very, very excited about if we see it.
Well, Leland, when you talk about what markets get excited about, they get excited about the support that Chinese government officials will provide the market. And they've been able to do that perhaps more than some people had expected because of the lack of inflation that we've seen in the region. At what point does that shift, right? I mean, it's sort of which side of the evil are you on? Do you have no consumer activity and no inflation, or do you get a revival and then the same inflationary impulse that you're seeing in the rest of the world?
Yeah, that's one of the most interesting stories coming out of our second quarter data, because the Fed is looking at this and has to say, like, this is great news. And the reason it's great news is that you had this real threat that you would have surging inflation out of China, either because the supply shocks shut down ports, shut down logistics, and would cause a supply shock, surge of inflation in the United States, or you'd have this wonderful bounce back in June and in July and others, demand back, and then you'd have surging commodity prices. Amazingly, it looks like they thread the needle between not being too much and not too little. So we're not seeing that surge of inflation coming out of China just yet. But this could change very easily if things get much better in China, if things shut down again. So for right now, the Fed has to be very happy, but for just right now.
Leland, with all of your skills, your reading of the culture of China, what does the next Hong Kong look like?
Well, I mean, are we talking about the future of this Hong Kong? The future of this Hong Kong is quite dreary. I mean, this is just another Chinese city at this point. It's been sad to look at Hong Kong be what it once was and now become, a secondary city of China that's pushed its expats out. It's pushed it because of the politics.
What should Western banks do? Leland, you're advising Mr. Diamond, Mr. Moynihan, and the rest of them. What should Western banks do with the next Hong Kong?
Well, they're pretending to stay, but most of the people I know are actually moving through the back door out to Singapore already. So they want to make sure they're not offending the Chinese government by moving en masse out of Hong Kong. But no one wants to be there. Between the national security law, between the COVID crackdowns and quarantines, very little appetite for expats in particular to be in Hong Kong right now. And so you're seeing an exodus. Even if Hong Kong markets stay relatively important going forward, you're seeing a massive exodus of people people, and it's no longer the financial capital it once was.
Leland, thank you, sir. Leland Miller there of the China Beige Book International. Just as we were conducting that interview, having that conversation, I was just going through the estimates for Chinese growth this year. I don't think I can say I've ever seen so many forecasts with a 3 handle for Chinese economic growth. UBS, Morgan Stanley, Nomura, Barclays, Deutsche Bank, Natixis, Bank of America, BMO Capital, the list goes on and on, Tom. ING, Pantheon, AXA, JP Morgan, Danske Bank, Mizuho, BNP Paribas, TD Securities, just on and on. All of these banks looking for a 3 handle. The median has a 4 handle, just. But Tom, that's the picture for Chinese growth this year. It has changed in a material way over the last couple of years. People are looking for something we haven't seen in a long, long time.
The run rate is 6%, let's say, and you're going to have it to 3%. And then what does that mean for the Pacific Rim, just for starters, John? And that's why you see the IMF and other institutions start to follow. I believe it's WTO, with sub 3% global growth. That's a statistic no one, including Michael Feroli's, ever thought of.
And a lot of people might consider that a global economic recession, eh, Tom?
Absolutely. There's no question about that.
Michael Feroli is going to join us next, the chief US economist at JP Morgan, looking ahead to Chairman Powell tomorrow. Some ISM data, PCE data, a whole bunch of data coming up this week. From New York, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Crypto You have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance, and here is your price action. Equities elevated through most of this morning. We stay that way, just up 0.25%. The move fades in the last 10 minutes or so. On the Nasdaq 100, up just about 0.1%. Yields backing away from session highs as well, in and around 325 briefly, up by 2 or 3 basis points now to 323. In the commodity market, Tom, that fades too. 110 on WTI, up by a little more than 1%.
Let's get right to it here with a VIX 27.01. Michael Ferroli is the chief U.S. economist at J.P. Morgan. The world stops at 7 p.m. on Fridays when he and his clan release their weekly prospects. We get a lead on that into this week as well. Michael, how will your weekly prospects on Friday change with the anticipated PCE deflator statistics hours before?
Yeah, we'll have to see what kind of data we get between now and Friday. I think on the PCE number, a lot of that is already foreshadowed by the CPI and the PPI. I'm perhaps a little more interested in seeing what we get in jobless claims and in the ISM report. I think there has been some signs that the economy is losing a little momentum. Some of those indicators have been, a little more worrisome than others. So I'm going to want to see what the activity data we get Thursday and Friday say.
Is the character of a growth recession not an outright NBER gloom recession, but just a slowdown, the sluggishness that maybe you and Bruce Kassman are writing about? Is that about a domestic economy flat on its back, or is that the international component folded into it?
I think it's more about the domestic economy, but I would point out that the real trade-weighted dollar is up pretty significantly. So we are going to be essentially having some trouble, I think, with external performance as well. Perhaps that's one reason why we are seeing some of these signs that the factory sector is now following the housing sector lower. So I think it's going to be mostly driven by Fed policy, intended Fed policy, but I think some of those effects will be felt globally. But, we'll have to see how much global growth also slows. Obviously, Europe is slowing here. That's not going to help, but so far we're also expecting kind of a controlled descent in Europe.
Michael, earlier in the show, Tom was talking about a really important point about the deceleration of inflation not being enough. And at what point does the Fed say, okay, we're good. We can allow things to remain a little bit hotter than they had been over the past decade in terms of inflation and not raise rates to the point where we know that we're going to torpedo the economy. Michael, do you believe that that impulse is on this Fed, or that they really are committed to getting things back down to 2% inflation over the near term?
I think they are committed to getting inflation 2%, maybe not in the near term, but in the medium term. And I think in my mind, one of the big debates right now, or big uncertainties, is the Fed has been talking about essentially taking an outcome-based approach to fighting inflation, which is to keep raising rates until inflation gets close to 2%. That would be a change from past procedure where they were more forecast-based. So if they were, normally you would think if you saw the unemployment rate rise and payrolls decline, then you would wait for the effects to follow through in spending and in prices. So I think that, that's a big debate right now, is whether if we do see further weakening in activity, is that enough to get them to dial down the pace of rate hikes, or are they going to just keep going until we get back down to 2%?
Michael,
I tend to think they'll be a little more forecast-based.
So based on what we're hearing, and based on the discussion about the R word that we had last week that seems to have faded a little bit with this consensus for a softish landing, what are you seeing in terms of a recession probability, not with respect to a downturn or some sort of technical definition, but in terms of the nature of how prolonged that downturn could be?
So it's not our baseline scenario, but it is obviously very elevated. We don't think it would be a very severe recession. Certainly, there aren't the types of imbalances we had in 2008. So we don't think it would be a severe one, but it could be a long one, particularly if in that recession the Fed once again is pinned at the zero lower bound, in which case they wouldn't be able to provide a lot of stimulus to generate a speedy recovery. So I think it should be a shallow recession, but it could be bit longer than normal.
How does the dollar break? Everyone has been, not everyone. We got to be careful here, Michael. But how does the dollar give way? The resilient dollar has been a lonely and very successful call. How does it actually give way?
I think the simplest way would be for the Fed to feel a little more comfortable that they are achieving their goals and that they don't have to be quite as aggressive in raising rates. I think that would be the simplest way you could get the dollar to cool off here.
Okay, I need a single point estimate, Michael, because no one's, it's just you and me. But if the inflation trend comes down from 8-9%, where's the kink in the glide path where the Fed changes its dialogue? Is it at 5%? Is it at 4%? There's got to be a point where they shift the rhetoric.
So I would tend to think of it more in sequential terms. I think if monthly, core CPI numbers come in under 0.3, then I think they can.
Okay, interesting.
Yeah, I think they can dial down.
We're speaking with Michael Feroli of JP Morgan as we head toward earnings, particularly kicking off with the big banks. And Michael, I've been noticing that capital markets have been slowing down in a very dramatic fashion. We've seen certainly financial market conditions tighten, but you can see in the IPO market, which is just a fraction of what it was last year. You could see it in the high yield debt market, just a fraction of what was last year. How much is that going to pose some sort of credit issue that does get the attention of the broader market in a new way? How much do you see signs of that being a risk?
So you're obviously seeing slowdown capital market activity, but we're not yet seeing any elevated signs of credit risk that would suggest a problem there. So I think I'd want to distinguish the activity from the actual credit risk. Obviously, if the economy does slow sharper than expected, then we have to revisit that conclusion. But right now it looks. I don't know, I'd say flashing yellow.
So given the sense that people think that the credit markets will hold in, and they have held in despite some of the tightening because a lot of companies have extended the maturities, does that mean you could see much worse financial markets performance than the underlying economy? Because the Fed tightening is aiming for reducing some of the froth from that market, but that it might not trickle into the real economy so quickly based on how much of the financing has already been held in place, and based on the fact that a lot of people are removed from that activity in some sort of direct way?
So look, I think we got to keep in mind that there are several channels of monetary policy transmission, and I think in each cycle, some are more potent than others. I think we've already talked about one, which is the dollar, which I think will be feeding through into the real economy. I think we're starting to see that also feed through into weaker import prices. I think we're seeing the mortgage rate effect already having a pretty pronounced effect on housing activity. So we got to keep in mind it's not just one channel through which monetary policy operates. I do think we're seeing, and of course some of the wealth effect too, since the beginning of the year. So I do think that there are definitely real channels that are still operating, and I think you're starting to see the fruits of that in slower economic activity.
A bit of tasting fruit, that's for sure. Mike, we've got to leave it there. Michael Feroli there of JP Morgan. Mike, wonderful to catch up, sir. Thank you very much. Just getting some headlines from Jake Sullivan, Lisa, the National Security Advisor to this president. We've talked a lot this morning about maybe some contradictory goals, some objectives over the next couple of days for G7 leaders. On the one hand, at the G7, they're exploring these oil price caps on Russian crude. On the other hand, they're set to label China, what was it, Lisa? A systemic what? A threat? Systemic challenge?
Systemic challenge. I'll get the exact wording just to make sure. But this has been an issue and a complete about-face of prior communique because they haven't really mentioned China. But sort of parsing out what you've pointed out, which is the really important trading partnership that they have with China. And I'm talking about they being all NATO countries. But also, how do you not poke the bear too much at a time where you're trying to sort of get them to come along with you?
And how do you introduce an oil price cap on Russia if you antagonize China, which you need to be part of that effort, otherwise it just doesn't really work. What we're hearing from Jake Sullivan, and this is why this is worth mentioning, is that they've started discussions with India on price caps. That's something Anne-Marie mentioned a little bit earlier this morning, Tom. You need to get India on board, you need to get China on board. It's a big, big effort.
That's where I wanted to go, John, is all of this is futile because of India. I mean, there's a triangulation here. It's always been that way. I mean, it's been that way back to, I'm not going to say World War II, but certainly back 30, 40 years. You try to go China, Russia, Russia, China, China, Russia, and then you've got the elephant in the southern room in India. It's more complex.
It's highly complex. And Lisa, for that matter, I think a lot of people doubt the likelihood that the G7 can come up with something that in practice will actually work and be effective.
Yeah, just to highlight how complicated things are. Jake Sullivan also talking about the tariffs. Remember the tariffs from the Trump era that were put on Chinese goods? There's been a lot of discussion about removing some of those tariffs in order to alleviate some of the price pressures, since they basically increase the prices for the end consumers in the United States. So how do you send a message? What message are you sending on one hand if you want to, for the own benefit of the U.S. consumers, remove those tariffs, but you also want to send a message? It becomes very complicated.
Lisa, it's beyond complicated. You want to call them a systemic challenge at the NATO level. At home, you've accused them of genocide. And at the same time, you're going to remove some of those tariffs because you're facing domestic pressure politically because inflation is too high. Tom, foreign policy has become a big issue, and they've had to backtrack on several issues on the foreign policy front on the international stage because of domestic inflationary pressures.
Exactly.
China, one. Russia, that's the one they're committed to. I'd throw in Saudi as another one that they might have to backtrack on in the coming month, Tom.
The adults that I listen to, John, are talking about the military expanse of the United States of America to reaffirm what we're doing in the Western Pacific. I thought Robert Hormats was brilliant on this, I'm going to say 2 months ago. What's the plan to reaffirm showing the flag in the Western Pacific? That goes against all these headlines. Easy to fix headlines about Russia.
Yeah, I'll reaffirm this. We're in the cheap seats. This is a really difficult job. Really difficult job.
Absolutely.
This is highly complex stuff. Futures up 1/3% on the S&P. Yields higher by 3 or 4 basis points. Your yield on a 10-year, 323.57. Bob Doll of Crossmark joining us at the opening bell on Bloomberg TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. NATO is set to label China a systemic challenge when it outlines its new policy guidelines this week. Bloomberg's also learned that the US-led alliance will highlight Beijing's deepening partnership with Russia. Still, NATO won't go as far as to call China an adversary. A Russian missile attack on a shopping mall in central Ukraine has killed at least 18. Authorities say dozens more were wounded and more than 30 are still missing. Group of 7 leaders meeting in Germany called the attack a war crime. And British socialite Ghislaine Maxwell finds out today if she will spend the rest of her life in prison. In Manhattan, a federal judge will sentence Maxwell on charges that she engaged in a scheme to lure and groom young girls for sexual abuse by former boyfriend Jeffrey Epstein. Prosecutors want a sentence of 30 to 55 years. And the push by Goldman Sachs into consumer business hasn't been cheap. Bloomberg's learned the firm's internal projections show losses from the business accelerating to more than $1.2 billion this year. The losses stem from the addition of new business lines, pandemic effects, and higher expenses. Plus, new accounting rules will force Goldman to set aside more money as loan volumes grow. And Credit Suisse is seeking to emerge from 2 years of scandal and losses as well. The Swiss bank is promising to boost its business with rich clients and cut costs by simplifying technology. Credit Suisse plans to grow its wealth management unit by focusing on priority markets such as Hong Kong and Singapore. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think institutions need to be very prudent, focusing on liquidity, dry powder. It's a time to protect capital, not to shoot the lights out, to get some great return. Right now we're in, I do think we're going into a recession, and that's a totally different playbook.
Paula Volent, she is the giant of Bowdoin up in Maine, and she has moved to Rockefeller University as chief investment officer after early years at Yale University under the late, great Mr. Swenson. David Rubenstein in conversation with Paula Volent. This is a really, really important conversation for endowment and institutional Wall Street. David, this is a woman with a track record second to none in investment management. Trace the trail from Yale to the stunning brilliance at Bowdoin, and now to the challenges of Rockefeller University.
Paula was trained as an art conservator, and she basically was in art conservation. She decided to go to Yale Business School, Yale School of Management, and while there, she did an internship for David Swenson, who was running the Yale Endowment. She was really liked by him. She helped write his outstanding book on portfolio management, and then she got a job at Bowdoin, where she managed the endowment. And at Bowdoin, the last 10 years there, she outperformed the Ivy League in every single category in terms of return of every other Ivy League manager, including David Swenson. And she did a spectacular job in the 20 years she was at Bowdoin. And on Bowdoin, her chief the chairman of her investment committee was Stan Druckenmiller. So she's been a kind of protege of both David Swensen and Stan Druckenmiller.
What's interesting here, David, is the backdrop is the worst bond market that you and I have ever seen. It's been one of my missions of the last 90 days to go, hello, everyone, down 12%, maybe down 18%. How do people like her, and how is she at Rockefeller University adapting to yield up, price down?
Well, she's very cautious. Her view is we're probably heading into a recession, and her view is you don't try to knock out the lights by going for super returns and getting the high-flying tech kind of companies. That's not what she does. She's protecting her downside, and I think she's a very cautious investor. Remember, over the last 10 years, she outperformed every single Ivy League endowment. And last year alone, before she left Bowdoin, she had an internal rate of return of over 50% for the last year she was managing Bowdoin's endowment. So she's quite impressive, and Rockefeller has done very well to get her to be the chief investment officer.
David, one of the big distinctions for endowments where people have been seeing outperformance has been their use of private markets, their use of alternative capital. How has she folded that into the call of a traditional 60-40 to get that kind of internal rate of return?
Well, of course, the Swensen approach, or the so-called portfolio approach, is to use a lot of private investments, and she did that as well. The trick she had was that getting into these best funds, because Bowdoin wasn't as famous as some other organizations or universities, and so she had to talk her way into some of the best funds. Inevitably, the marks will come down for some of the venture funds, and probably, therefore, she and some of the other Ivy League endowments won't have as good a return this year as they had last year. On the other hand, her returns are so good, it's not likely to go down all that much, in my view.
How much is she actively trading into a time of such uncertainty versus having a long-term view post-recession that she sees and sort of sticking to her guns on it?
My view is that she doesn't think she should try to knock out the lights by going for things at the absolute bottom of the market. She's very cautious, conserving some cash. She's in some very good funds now, but now she's remaking the Rockefeller portfolio because she inherited it from somebody else, but who was very good as well. But she's remaking the portfolio into something that is more comfortable for her.
Tell us about Rockefeller University. This is not the normal school. I think of David Baltimore in my youth and what he did with mRNA and virology onto the miracle of what Pfizer and Moderna did as well. It's not Bowdoin, is it? No. It's not Duke, is it? They don't have a basketball team, do they?
I don't think Rockefeller has a basketball team that I know of, but it's in New York City on the east side. It basically is an organization that does medical research and health-related research. Right. Yeah. And it's a highly intensive place. A lot of Nobel Prize winners have been there and are there. It's a highly specialized organization, and it depends to some extent on its endowment, because the Rockefeller family is not now putting in a lot of more money. So the endowment's very important to that organization.
David, given the fact that you work in the private markets and you talk to these investors all the time, perhaps, big and small, how much do you get the sense that they are following in the same kind of path as what we heard just now?
Well, everyone is recognizing that the market is down, whether it's a bear market, a recession, or whatever you want to call it. It's obviously down from the peaks, and people are debating how much longer it's going to be down before it goes back up. People who are very cautious are basically not trying to set records right now. They're kind of seeing where the market's going. But there are some people who see there are great values in the market, and the so-called value investors are now seeing that we're touching near the bottom in their view, and they're going back into the market. So I don't really think the market is likely to go down that much further from where we are, and I think there's enough cash on the sidelines to go back into the market and keep the prices of some of these stocks at reasonable levels. But we're a long way away from being out of the woods, in my view.
David Rubenstein, thank you so much for joining us. And of course, this is an important conversation, critical for anyone within institutional Wall Street and the endowment world. Paulo Valent, Bloomberg Wealth, look for that. Terminal is asleep. It is not. There are some really interesting nuances here with a 10-year yield out to 3.25%. And what I'm really focused on, Lisa, is yen struggling to go weak yen and maybe breach out into new weakness.
What we're seeing right now is a lack of certainty played out in markets. And the nudginess that you talk about all the time is interesting and important, especially in light of some of the weak liquidity in certain markets. The lack of certainty, how do you trade around this? What are you even trading on? Is it just the University of Michigan sentiment survey, or is it every single Dallas Fed survey, et cetera?
Kay Schiller here coming out, folks. You're going to look for that, I believe, at 9 o'clock. Yes, 9 o'clock. And what's interesting, that's dated material. We're going to get the April statistic on Kay Schiller. But Lisa, again, housing up 21%. Far beyond what we witnessed in 2006 and into 2007.
Yeah, and even if there is a cooling down in housing prices, it's going to take a long time for the transmission mechanism to find its way into rents that are not climbing at such a rapid pace.
And we'll have to see futures up 15, Dow futures up 143, and the VIX, one of the positive stories here in the quiet, from 32 down to 26.90. Please stay with us on radio, on television. This is Bloomberg.
Welcome back to another special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Bridget Condon. The 135th edition of the championships are underway in London. Reigning U.S. Open champion Emma Raducanu clinched her first career win on center court with a straight sets victory over Alison Van Uytvanck. The Brit gave the home fans plenty to cheer on her way to the second round. A year ago, the 10th seed was ranked 338th in the world. Up next for Emma, Caroline Garcia. And defending champion Novak Djokovic also enjoyed a good opening day at the All England Club. The six-time champion took out Soon Woo Kwon in 4 sets to set up a meeting against Aussie Thanasi Kokkinakis. Djokovic can claim his 21st title at the Slams if he lifts the trophy next weekend, closing the gap with Rafael Nadal in the all-time list. And don't forget, Tennis Channel's daily coverage from London all starts at 4:30 p.m. Eastern. I'm Bridget Condon.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City this morning. Good morning, good morning. Looking to achieve something we couldn't achieve yesterday. Getting these gains to stick. Equity futures positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, waiting for the next shoe to drop.
The last shoe to drop that we could see is earnings, second and third quarter earnings.
The question is now on earnings.
It is an extraordinarily tough environment in which to forecast.
I do not think earnings have been well understood.
The market's expecting around 220 peak earnings.
Analysts are sitting there like deer in headlights.
PEs have started to contract.
Something of a consensus that believes that earnings are too high.
There's a little bit of a wait and see.
They're going to have to come down at some point.
The market will have to fall further.
There's very little proactivity among the bottoms-up analysts.
I think it's going to be a challenge.
We just don't see how we don't get a recalibration here.
Joining us now to discuss is Bauer Stocks' Emily Hill and Krishna Mamani of Lafayette College. Emily, first to you. Do you agree that's the next shoe to drop? What happens with earnings?
Yes, I do. We're already seeing forecasts revised downward, and I think it would be actually a surprise if we didn't see earnings, disappointing earnings coming across in the next quarter. So yes.
I want to share that Lisa Shallett quote with you, Krishna, and just really elaborate on it if you can. Economists have begun to cut their top-down economic forecast for GDP, and yet fundamental company analysts are sitting there like deer in the headlights, not knowing what to do with the numbers. Krishna, so much of this seems to be obvious to so many people, yet the downgrades aren't coming through. We're not seeing the cuts. Why do you think that is?
Well, I think the primary reason for that is growth is still decent. And the headline, the top line revenues, which have to come down, haven't really started coming down as much. So I can see why the analysts are kind of waiting to see how things will work out. There is a likelihood that earnings go down, but I think in the current environment, unless things slow down substantially, and that's probably not happening this quarter or next quarter, I think earnings would be okay. Even if they do come down, they're not coming down a lot.
Krishna, just to be clear, where do you expect the economic pain to turn up in 2022?
So I think, again, the policy acts with a great deal of lag, and that's something that we have to realize. You know, the tightening that has taken place and what is going to take place in the future, the impact of that is probably more in 2023 than it is in 2022.
Emily, would you agree with that assessment?
I'm sorry, I don't agree with that assessment, because I think one of the things we're seeing is that input costs have risen substantially, and we're finally starting to see declining consumer demand. You know, the American consumer is just the engine that won't quit, and despite poor, very poor, record low consumer sentiment, we'd still seen consumers have continued to spend, and we're finally seeing that fall off. So I think the impact to earnings is going to come sooner, perhaps, than you expect.
Krishna, what's the counterpoint to that?
Well, so again, I go back to the fact that policy, monetary policy, the impact of that on growth and the impact of that on outlook for growth is substantial. But the impact of that on growth itself acts with a great deal of lag. So we are going to see, and you see that in employment. That is, the impact will be there, but it is not going to happen immediately. It's going to happen with a few quarters lag.
Emily, you expect to see the pain sooner. So walk me through where you expect to see that concentrated. Is that a broad-based story across a range of industries, or is it more concentrated for you?
Well, I think we're going to have a broad. It's going to be concentrated in consumer discretionary, in the sectors that are responsive to consumer demand. And I do agree that the monetary changes that the Fed is instituting will take longer to reverberate through the economy. But some of this, the impact on consumer demand, look, there's been massive wealth destruction. $15.5 trillion of wealth has disappeared. So this is where, and $2 trillion of that alone is in cryptocurrencies. So, you know, this is somewhat arguable, but with every dollar of wealth decline, consumers typically spend about 3 to 5 cents less. So it's actually been surprising that the American consumer has just continued to spend right through this rising inflation, through this onslaught of bad news. And so I think the parts of the economy that are dependent on consistent consumer demand will struggle, not just in 2023, once the impact of tightening reverberates through the economy, but in the next quarter or two.
Krishna, it's hard to push back against that. Goldman seems to be on board with it, a range of price target cuts in the last 24 hours on a range of retailers, Walmart, Target, Restoration Hardware. Is there any pushback from where you're sitting against that view when it comes to consumer, Krishna, and that pain is going to come very soon?
Well, I think for consumer pain to materialize, it won't be because of wealth effect. The net impact of wealth effect at most is probably 1% in growth terms. Where the consumer is going to hurt is when employment starts coming down. And that hasn't really happened. If it had happened, the party that would be most thrilled with that would be the Fed. That certainly hasn't happened. And as long as employment remains good, consumption is going to will remain supported. You know, it's definitely going to soften, but saying that the impact of the wealth effect and the price increases, the impact of that is going to be substantial in 2022, I find it hard to believe.
24 minutes away from the opening bell, equity futures positive about 0.5%. Nike One stock we've been watching since the close yesterday. That stock is down a little more than 2%. Same old story, China, supply constraints, all of the above. Taylor Riggs has more. Hey, Taylor.
And John, this will get us into that story, right, about some of the supply chain issues, some of the bullishness, some of the health of the U.S. consumer. First, let's sort of come into this thinking about where the strategists are, the great conversation you've been having in the last 6 minutes. S&P analysts, according to a survey that we've done, are actually some of the most bullish they've been in about 20 years. I'm looking on a scale of 1 to 5. If 1 is a sell, 5 is a buy, on average, analysts are about a 4, the highest and sort of most bullish that they've been since about 2002. I think what's interesting when you look at this chart is it's actually they're the most bullish in the top quintile for the stocks that are off the most relative to the 52-week high, on average, a 29% drop. So is that a lot about a valuation story, right? Coming in and just thinking that they've sold off so much that they're actually starting to look attractive. Let's end on Nike, where we started. When you think about sort of the Goldman strategists coming in and saying profit margins are too rosy, we heard a little bit of this with Nike yesterday. The health of the North American consumer, which has been the huge sort of bullish story of Nike, falling just a little bit. If that top line starts to fall just a little, how does that impact the bottom line? That is sort of the big question when you think about the equity market rolling over, but profit margins and the profit margin forecasts are steady. How does that work out? How does that sort of divergence go from here?
I'm trying to work out a whole range of these issues. On the one side, Taylor, you've got the likes of Goldman saying things are too rosy, and then you've got Citi saying things will be better than feared. On the earnings front. Then you've got JP Morgan saying that the average investor expects an economic disaster. I'm not sure how you gauge what the average investor expects or how you come to the conclusion that they expect an economic disaster. At the same time, Taylor, I'm looking through this in the same way you do. Everyone says things are very gloomy, but I look to Wall Street and it looks very divided. I can still find some big bulls out there on this equity market.
I'll bring you one, maybe Jonathan Golub, right? You know,
Sure.
He's more of the quant at RBC, and he said that sort of the indicators that he's looking for, the dispersion in those analyst estimates aren't there. Once you start to get more of that big divergence, maybe you'll start to show some cracks, but for now, I think pretty positive according to him.
Taylor Riggs, thank you. Wonderful to catch up. Taylor with us through the hour, hopefully, for a few more times. I want to share this quote with you from JP Morgan's Marko Kolanovic, who said the following: "It's not that we think the world and economies are in great shape, but just that the average investor expects an economic disaster, and if that does not materialize, risky asset classes could recover most of their losses from the first half." Now, it's not for me to disagree with the forecast. I just want to work through the process. Can I get your thoughts on that, Emily, that the average investor expects an economic disaster? Would that be your view?
No, I definitely don't expect an economic disaster. I do think we are in the middle of a bear market rally, and but to Taylor's point, stocks are certainly at a better value than they were at the first of the year. So I'm not a total bear by any means. And I think that if for people with significant amount of cash on the sidelines, the next few months is a good time to be gradually putting that to work, especially because cash drag has, 2 years ago, there wasn't a big penalty to a portfolio to holding huge amounts of cash. But no, I'm not expecting an economic disaster. I don't really think that retail investors or American consumers are either. I think you've got very, very record low sentiment, and primarily because of inflation. But I think that the reason we're seeing this very robust bear market rally, which I think could easily continue for a couple of weeks, is because people are relieved that things are not worse than they anticipated. So basically, mixed answer to your question there.
Yeah, Morgan Stanley agrees with you, Emily. They think this can go on for a few more weeks, but ultimately it's the reality check that comes from earnings that takes us back down towards maybe 3,400. Krishna, what I'm trying to gauge is how low the bar is going into earnings season. I've got people telling me that the earnings expectations haven't been cut enough. I've got Marko Kolanovic over at JP Morgan in his latest research, which basically implies the bar is really low because the average investor expects an economic disaster. We won't get one, and we can recover the losses of the first half. I guess from your perspective, Krishna, which one is it?
Well, so, when the markets or S&P, for example, is down less than 20%, that's from a really high level. I don't think that's the market's expecting a total disaster. I think, and the other point is whatever drawdown that you have in earnings is not going to happen this quarter. What we have is decent employment, decent growth, and that will show through in earnings. If there is an earnings revision, that probably, again, as I mentioned before, probably happens in earliest the fourth quarter, more likely in 2023. And it's not unusual in a significant slowdown scenario for earnings to go down. That doesn't mean, but with multiples having already compressed, that doesn't mean that the markets could not rally. I think the driver for the market still is very much the direction of Fed policy. And that direction of Fed policy depends on the direction of the slowdown that we can see in employment. If that materializes, I think we have a floor. If that doesn't materialize, and if the Fed is committed to killing headline inflation, then we are all doomed.
Krishna, we almost went through a full segment without discussing the Fed, then you spoiled it. We'll talk about the Fed in the next segment, and we'll pick up on that point on what this Fed is actually targeting and what it means for this market in just a moment. Krishna and Emily are sticking with us. Going into the opening bell about 18 minutes away, equity futures look like this, up 0.4%, with some movers for you. Here's Abby.
John, well, behind some of that bullish tailwind that you're talking about for stocks, we have Occidental Petroleum rallying once again on the news that Warren Buffett's Berkshire Hathaway is buying more of the stock, 44 million shares. They now own more than 16% of the company. Some see these consistent buys by Berkshire Hathaway, the stock, by the way, up more than 500% from its 2020 low, as a path for a buyout. Vonage popping as Ericsson says it is fully committed to the $6 billion deal, wants to get this 5G, the motivation for the deal done by the end of July. Wynn Resorts up more than 6%. This is the China travel quarantine restrictions have been mainly lifted, or cut in half, I should say, but that's certainly a tailwind, or seen as a tailwind for Macau, more than 40% of the company's revenue. And then finally, you and Taylor were talking about Nike. There it is, down 2.3% on that forecast for sales for the year being a little bit light, the supply chain constraints, and of course, caution around China, John.
Abby, thank you. Coming up next, ECB President Christine Lagarde taking center stage in Portugal.
Inflation in the euro area is undesirably high, and it is projected to stay that way for some time to come.
That conversation up next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Inflation in the euro area is undesirably high, and it is projected to stay that way for some time to come. In July, we intend to raise our policy rates for the first time in 11 years. And we have provided some guidance for our September policy meeting and the rate path that we envisage thereafter.
If you get a chance to read it, decent speech from President Lagarde from earlier this morning, kicking off a busy week as central banks speak. Oppenheimer writing the following: the new week greets investors and traders with plenty to ponder as they measure the power of the rally. Uncertainty remains the order of the day. And Mike, that's not just true of investors, but true of central bankers as well.
Absolutely, John, and it all revolves around inflation. After all, the ECB and Fed have pretty much told us what they're going to do. Lagarde today reaffirming the ECB's base case of a quarter-point move later this month. And last week, Jay Powell, and since then other Fed officials, reaffirming the market's view that they could go 75 basis points. However, both of them, Powell last week and Lagarde today, saying things could change if inflation changes. And we get some inflation reports this week that are going to show changes, and they're probably going to show them higher. The consensus is the white line, which is the European CPI rate, is going to go up to 8.5%. For the Fed, the PCE index out Thursday is going to be up 6.4%. So that line reverses direction. Much higher inflation. Does that call for a change in monetary policy? Unfortunately, Lagarde and Powell speaking tomorrow in Sintra, Portugal, at the ECB's version of Jackson Hole. They're going to be on a panel with Andrew Bailey of the Bank of England and Augustine Carstens from the BIS, and our Francine Lacroix will be questioning them about their plans, but they won't have those new inflation numbers in hand yet, so we may not get a change in plans announced. But Lagarde did make some news today in Sintra, John. The ECB Friday will begin reinvesting proceeds from a runoff of its QE securities in a manner they call flexible, which means they can use the money to buy securities in specific countries to help prevent a possible debt market crisis as they raise interest rates. You can see in the little box there, Italian rates jumped above German rates earlier when the ECB started talking about raising rates, and they're afraid that we could see a replay of 2012 when spreads really blew out. The flexible plan, one way they're going to try to attack this. A lot of people think it won't be enough, and the ECB has tasked staff to come up with a new plan. She offered no details today. Maybe that is something that she can be asked tomorrow.
What a panel we've got coming up tomorrow. Mike McKee, thank you for that. Francine Lacroix, as Mike McKee pointed out, sitting down with Chairman Powell, President Lagarde, and Governor Bailey, all at the same time, working through a range of big issues. Krishna, I wanted to come back to you. I promised we get to that Fed conversation, so let's do that now. Your point is an important one. Trying to work out what they're targeting and what they're willing to tolerate and what that should mean for your outlook and for where you put money to work. Can you run me through your thinking right now, Krishna?
Sure. So the Fed is on a tightening path. And the question that you have to ask yourself is, what is it that the Fed is looking to do? If the Fed is looking to contain persistent headline inflation, that will probably run into 2023 easily. So that means that they will be on a tightening path for a much longer period of time than what the market is anticipating. If that is the case, the risk for asset prices is significant. Having said that, I think it is more likely that what they are targeting is basically employment costs getting contained. That is, unemployment going up and wage pressures moderating. If that's the case, then they may keep rates high for a long period of time. They may not cut, but at the same time, the pace of tightening may not be as high. And if that is the case, then we have a bottom in sight in the fall of this year.
Krishna, is that just a guess, though, trying to work that out? How much of a guess is that? How much of an educated guess is that?
Well, it is an educated guess. You know, the Powell at the moment continues to talk about headline inflation and how that is what they are targeting. But if that is the case, they very well know that the likely outcome of continuing to tighten to what Larry Summers may be asking, 5-6% at the policy rate. What we are talking about then is a very deep, severe recession that they would have a tough time coming out of. And I don't think they want to be in that situation. So it's an educated guess. They haven't articulated that policy, but that is what the markets are discounting right now.
There is a fear that they have to inflict some real economic damage. A fear that they have to inflict damage on this market, too. We caught up with Greg Peters of PGIM earlier this morning, who said he's betting against easing financial conditions. He thinks they need to worsen. Emily Hill, given what's happening with the world and the objective of policymakers right now, I would ask myself whether it's the right time to own an industrial. But you like Honeywell. That jumped off the page to me, Emily, and I wanted to give you the chance just to run through your thinking there before we close out this segment. Why Honeywell?
Well, it's the highest quality industrial conglomerate in the world, arguably. And it really hadn't done that well, frankly, post-pandemic. And it's positioned to take advantage of all sorts of innovative trends. And I'm not talking about buying Honeywell, by the way, for 3 months. We don't do that. We're long-term investors. But, you know, you collect a yield, you've got a very, very high-quality company, well-run company with an excellent balance sheet, and you're frankly investing in a company that does, you know, warehouse automation that is highly leveraged to ESG trends. And so I think it's a good time to invest in just very high-quality, large-cap value companies, whether they're industrials or not. Now, for the most part, we do prefer sectors that are a little bit more defensive. So utilities, consumer defensive, but Honeywell is the exception.
Emily Hill, I wanted to talk about that exception with you. Thank you for going through it. Emily Hill alongside Krishna Mamani there. With equity futures up about 0.5% on the S&P 500, on the Nasdaq up around about 1/3. Coming up, the morning calls, and later, investors looking for the bottom of this market. We'll catch up with Crossmark's Bob Dole at the opening bout from New York City. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Minutes away from the opening bell in New York this morning. Good morning. Equity futures just about positive on the S&P 500, up 0.4%. On the Nasdaq 100, up a couple of tenths of 1%. The bottom for the Nasdaq 100, June 16th. 2 days before that, the top for bond yields on 2s, on 10s in a similar period. Your 10-year right now, way off the highs of the year so far, which were 350 a couple of weeks ago, but backing up again, just by a couple of basis points to 321.30. Earlier this morning, in and around 325 on 2s right now, 311.37, yields in almost a single basis point. Lisa earlier this morning went through some of the auction supply that you need to look for. The 7-year coming from the Treasury a little bit later. That's the story of the bond market. Here are your morning calls. First up, UBS downgrading eBay to neutral, expecting shares to underperform until investors have better visibility into future growth. Your next call from JMP Securities naming MGM Resorts its top pick within the gaming sector, highlighting the rapid recovery in Las Vegas. That stock is up by more than 3%. And your final call from Evercore, cutting its Apple price target down to 180, seeing headwinds stemming from a strengthening US dollar and slowing PC demand. That stock just about positive, up 0.4%. Coming up, Crossmarks, Bob Dole says earnings estimates are still too high. He's not the only one saying it. Lisa Shallard of Morgan Stanley yesterday was absolutely scathing. We'll pick up on that story next. Your opening bell, just around the corner.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bow this morning. Good morning to you all. The state of play looks like this. Positive on the S&P by 0.4%. On the Nasdaq 100, up 0.2%. On the Russell, up around 0.8%. We sold the open yesterday pretty quickly. Let's see how this plays out right about now. There's your opening bow. Switch at the board and get to the bond market. Your 10-year looks a little something like this. Off the highs of the day, up a basis point on a 10-year, 321.49. In the FX market, some dollar strength in the mix in the last couple of hours. 105.30. Euro dollar negative 0.5%. Going into an interesting week for data on both sides of the Atlantic. We get some Eurozone PCE data on the US side and CPI data on the European side, and an ISM print on Friday on the US side as well, and a ton of central bank speak. So take your pick. At 1.1% on WTI crude, 110.80. China easing some quarantine restrictions, seemingly opening up this idea that we get more demand for commodities. We can talk about that through the day, no doubt, on Bloomberg TV and on Bloomberg Radio. About 40 seconds into this, let's break it down for you. Stocks up about 0.4% on the S&P with some movers. Here's Abby.
John, well, we do have a bit of a better open here relative to yesterday for stocks, with that S&P 500 up about 0.4%. One stock going in the opposite direction, though, and then we'll take a look at those that are helping. Nike shares are down by about 2%, more than 2%. This, of course, after the company basically gave a weak sales outlook, supply constraints continuing to cause a problem, and of course, the last quarter was down 20% in China, so fears that that weakness could continue. Shares now down about 3%. Goldman Sachs, on the other hand, up 1.7%. They, of course, along with Wells Fargo, hiked their dividend, leading the big banks by 20%. So investors looking to that, despite the larger losses from the company's consumer unit. ExxonMobil up 2.3%, in line with oil, and of course that optimism around the China travel quarantine being cut in half, perhaps more demand for that natural resource. And then Apple, you were just mentioning that too. One of the top point boosts for the S&P 500 today, John. This, of course, as Evercore has cut their price target, but to 180 from 220 on the possibility of dollar strength hurting and PC weakness. But of course, the stock is well below 180, so that still suggests lots of upside, John.
Abby, thank you. About 2 minutes in, here's the state of play for you, up 0.6% on the S&P. Every industry group on my screen is in positive territory right now. Abby talked about the energy names, Exxon being one. Energy stocks up by about 2.3%. Financials up by more than 1%. Shinali's going to be with us in just a moment. Information technology advancing just about as well, up 0.4%. On the West Coast, let's get to Ed. Morning, Ed.
Yeah, good morning, John. We're up around 0.6% on the Nasdaq 100, although that higher open didn't last very long on Monday, so let's see where it goes. We're also in the last few days of the quarter, right? There's some rebalancing of portfolios, which brings us volatility, but I heard you talking about the bottom on the Nasdaq 100 being June 16th. The other way I'd look at it is that we're still down more than 20% from our March high, and as we enter another corporate earnings season head on, you look at the year-to-date declines of the technology sector relative to the broader market, the Nasdaq 100 relative to the S&P 500. There's some feeling out there that corporate America and some sections of Wall Street are just too bullish. You look, we're up now 0.9% on the Nasdaq 100 following the open. China's easing of restrictions and requirements relating to COVID-19 seems to be supporting the market. But the question is still, how do we cope with inflation in corporate America? And once we look at inflation, we go back to the rate story. We're looking at the impact of yields recently. Last week, we had that best week since March on the Nasdaq 100, but that was at a time where yields were coming down. We've seen some yield volatility creeping in the last 48 hours. So I'll give you a silver lining, John, because I'm a nice guy and you're a good mate. At least with some of that trimming we've seen in the technology sector, the weighting of tech relative to the S&P 500 has come down somewhat, but at the index level, we're still hyper-focused on this sector because I want to know what they have to say about the consumer.
You're the happiest man at 6:30 in the morning in San Francisco, that's for sure. Ed, thank you, mate. It's good to catch up, buddy, as always. I promised you we'd talk about the banks announcing a wave of dividend increases following their stress test results. The Goldman CEO, the chief, David Solomon, said the following: our client-oriented strategy will continue to provide a strengthened return profile to dynamically manage capital and remain well-positioned to support our clients. With the latest, Our Wall Street correspondent, Shonali Bassett, joins us now. Hey, Shonali.
Hey, John. If you take a look at it, it's actually Morgan Stanley that is rising the most of all the big banks, more than 4%. And that's because they were able to also announce a buyback. With bank shares having fallen so much this year, more than 20% for most of the big investment banks, Goldman, Morgan Stanley, and JP Morgan, investors did want to see buybacks from the banks. But remember, most big banks muted expectations. Goldman, however, did spike their dividend more than any other bank, and that, according to Bloomberg intelligence analysts, really makes their dividend much more attractive, much more similar to JP Morgan. But remember, there was not all very positive news across all the banks. If you looked at JP Morgan and Citigroup, they held their dividend stable. JP Morgan cited a reason why, and that reason being higher capital requirements anticipated ahead. Citigroup has previously said also that this would be a tougher macroeconomic environment. I also have to point out that tougher macroeconomic environment for a second, because we did get Jeffrey's results here, trading results. Between both lighter equity debt underwriting, there was also lighter trading, particularly in fixed income. That tends to be a bellwether for the big banks. So will this year be as good as last year? What kind of capital is there left to not only bring back to shareholders at the end of the day, but also redeploy in the business to keep this year competitive, John?
Shonali, build that out just a little bit more. Just one further beat if we can. July 14th, JP Morgan reports earnings. We've heard the commentary from the C-suite, that hurricane headline from Jamie Dimon. What are you looking for in these numbers in a couple of weeks?
Yeah, is it as bad as even the Federal Reserve thinks it can get? Remember, and are there areas that the Fed is not seeing? If you think about it, the Fed stress test really surrounded around the commercial mortgage sector. It's surrounded around credit cards. But there are other pockets of the economy. What about the buy side? Where does trading get under pressure? In addition to the consumer banks that you have to keep an eye on when markets have been this choppy.
Shonali, thank you. And Shonali, bringing up Morgan Stanley, just bringing up the stock on my screen, up by more than 4% in the early part of today, 6 minutes into the session. Another stock to look at is Nike, at 1.8%, there and thereabouts, raising the losses of this morning. Nike reporting what some consider to be a disappointing outlook amid increasing disruptions in China. The CFO, Matthew Friend, saying the following: we expect gross margins to be in the range of flat to declining by 50 basis points versus the previous year. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, interesting turnaround for the stock here, considering it opened almost 3% lower, but maybe investors clinging to some of the positives, including the growth they saw in the EMEA region as well as Latin America. But of course, it was the headlines out of China specifically that really grabbed focus after this report, after the bell yesterday. Sales down 20% in that market due to the impact of COVID-related lockdowns, which Nike said affected 60% of its business there. But I would note also North America was a weak point. Those sales were down about 5 percentage points. And remember, that's Nike's biggest market, makes up about 40% of its total revenue. So our colleague Andrea Felstead over at Bloomberg Opinion says when you look at North America, that may be a sign of consumer demand shifting in the face of high inflation. If you're paying more at the grocery store and at the gas station, maybe you're not going to buy a new pair of sneakers or more athleisure. And you have to pair that knowledge with the fact that Nike's inventory was up 23% to $8.4 billion. A big reason being there are many goods stuck in transit. So Nike says it's going to do more discounting in order to work that inventory down. And that brings us to the margin point, John. As you said, flat to down 50 basis points, not the best news. And analysts really are looking at the fact that Nike says its direct-to-consumer business should help buffer margins. Some are more skeptical, including one over at BMO Capital Markets who cut his price target on the stock today. He's not the only one. And I would note that a lot of these headwinds analysts are talking about, China, supply chain issues, margin pressure, are not unique to Nike. They weigh over the consumer discretionary sector as a whole, which, like Nike, is down about 30% year to date, underperforming the broader market, John.
Some brutal numbers there. Kelly Lyons, thank you very much. I'll tell you someone who was absolutely brutal yesterday. It was Lisa Shallett. I go back home in the evening and I go over all the interviews again and make some notes. And I really wanted to bring you Lisa Shallett's comments all over again from this program yesterday. Take a listen to what Morgan Stanley's Lisa Shallett had to say.
Economists have begun to cut their top-down economic forecasts for GDP, and yet fundamental company analysts are sitting there like deer in headlights, not knowing what to do with numbers.
Sitting there like deer in the headlights. That's not Crossmark's Bob Dole. He joins us right now. Bob, let's talk about that. Do you agree with that sentiment, that statement that Lisa Shallett at Morgan Stanley's made?
Look, I think analysts have undercut estimates now for several quarters, so I think they're reluctant, despite Lisa's good comment. The economic numbers are coming down, so they're setting themselves up to have to take some numbers down, but I think they'll probably, in many cases, wait until the quarters are released and see what guidance they get for the back part of the year. To defend corporate America, John, you know they've done a great job raising prices to keep up with cost pressures in labor and transportation and raw materials. The question is, how long will you and me and businesses pay those higher prices? And I think we're coming to the end of the rope. So I'm going to agree, earnings probably are vulnerable here.
So, Bob, walk me through what that means for this market going through this summer and into the end of the year.
Well, I think it means it's going to be choppy. I don't think it has to go straight down. You know, we're in a period where perhaps good news is bad news and bad news is good news. Example, last week, growth was a little bit slower. Some signs maybe inflation's peaking, and the market likes it, takes off on the weak news. So if we get weak earnings, we may offset it by some pickup in PE ratios, which have gotten hammered so hard since the first of the year. So I think we're going to have a very choppy period. I do think short term, we're in our third bear market rally since this bear market started, and it's maybe only half over.
You're happy to call it that, though, Bob? This is a bear market rally, what we've seen over the last week.
I don't think we've seen the bottom, John. I want to see more capitulation. I want to see the VIX climb over 40. I want to see put-call ratios expand. And fundamentally, I would love to see some visibility on potential peak in inflation, peak in interest rates, and some visibility, we're not even close to this one, on the Fed getting the end of rate increases. That's what I'm looking for to get the final washout bottom. I think that's still in front of us.
And let's throw in this one as well. Peak dollar. Do you think we've seen that, Bob? Because looking ahead to earnings season, it could be a key feature of earnings. It was for Nike. It will be for others. It's going to be for Microsoft. They've already talked about that. Are you willing to fade the dollar strength? And if you are, how do you capture that in this equity market?
Yeah, I am, although in all honesty, I've been calling that since the first of the year and been wrong. I think the fact that relative economic growth in the U.S. has been better, our Fed has come to the fore to raise rates faster than other central banks. That's given some resultant and latent strength in the dollar. But I think the dollar is overvalued. We're going to see some weakness. So that tells you got to be careful about how many multinationals you have in your portfolio, and make sure you have some non-U.S. The non-U.S. averages are down less than the U.S. so far this year, which has surprised a lot of people, John.
I get nervous, Bob, when a lot of people start coming on saying bad news could be good news, and I just sit here thinking, good news for what? One thing that's jumped out to me, Bob, and I'm sure it has to you, is the amount of people that talk about heightened recession risk, but then talk about a long in energy names through the rest of this year. I just wonder how much longer that can persist, Bob.
I think you're right, and of course we saw last week the energy stocks absolutely get, and the week before, underperforming significantly. And in some ways, that's a good sign. Typically, the last thing that gets hit are the strongest stocks. They got hit. Although I think the energy story is not over, but you're right. Energy, I like it, and recession in the same sentence are a little hard to fathom.
Bob, just a final one from me. If you had to sit in a pocket of this equity market through the rest of this year with a degree of confidence, can you think of a part of this equity market that you'd like to do that with?
I want to do it in high quality. Earnings delivery, earnings predictability, balance sheet management. HMOs are a good place to play it. They've done better than the market, but that's a place I'd hide. We talked about the financials earlier. I like them too, but was not mentioned insurance. They're some of the safer places too, I think.
Hey, Bob, awesome, as always, to get your view on this program. Bob Dole of Crossmark, thank you, mate, appreciate it. About 13 minutes in, we are positive by 1% on the S&P, on the NASDAQ by about 0.9%. Big week coming up for central bankers and global leaders. Up next, the US and its allies ramping up the pressure on Russia and China.
Our new concept will guide us in an era of strategic competition.
That conversation up next.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
So, for all those Republicans in Congress criticizing me today for high gas prices in America, are you now saying we were wrong to support Ukraine? Are you saying we were wrong to stand up to Putin? Are you saying that we would rather have lower gas prices in America than Putin's iron fist in Europe? I don't believe that.
Pretty strong words from the President of the United States, using the international stage to push back against those at home and abroad. G7 leaders now turning their attention to China, calling on Beijing to urge Russia to stop its military aggression and immediately and unconditionally withdraw its troops from Ukraine. This according to the text of a statement. Bloomberg's AMH Anne-Marie Tadeo join us now. Anne-Marie, before you depart Bavaria, talk me through what we've achieved in Germany at this G7 meeting.
Well, John, a lot of the stuff that was achieved in Germany is really just setting up the stage for more talks to continue. Of course, there's a lot of urging of on a number of factors. That's for the unity, to maintain that unity with amongst the G7 and its allies, to support Ukraine, to keep the pressure on President Putin, and then, as you mentioned, of course, to make sure they are steadfast when they are combating against China and urging China to lean more towards the West and stand up for Western values and not continue this support, even though sometimes it's behind the scenes with President Putin. Most interesting, which really got a lot of the talk, of course, is this idea of an oil price cap and as well as a Russian gas cap in Europe. Daniel Flatley, our colleague, just wrote a great piece talking about how it's a Rubik's Cube, and the fact that it got into the text, that they want to even continue discussions, is a big deal. But for this to actually hit the market, it is going to take a number of laborious conversations with the private sector, insurance companies, shipping companies, as well as massive buyers, especially for crude. Beijing being one, New Delhi being the other, and then Russia, of course, being willing to sell that crude for the cap that Western allies decide on.
Now, this is question number one for me, Maria. Just listening to everything that AMH has just gone through, how do you achieve that oil price cap that they're looking to talk about without including India and China? And at the same time, the president's going to go from Bavaria over to Madrid. And there's the potential for NATO to criticize China. At the same time, they need China on board to do something about Russia. Maria, can you square that one for us?
Well, it's a difficult one to square, but the focus, of course, as you say now here is NATO. But the way they see it is that this is not about the oil cap. It's not about specific countries like India and potentially China on the oil. This is a much bigger conversation now about security and defense. And what they argue is that we're going to see the most sweeping changes to that security definition probably since the Cold War. So this is about the weapons and the politics. It's a different type of conversation to that in the G7. Jonathan, if I could say, well, in my view, the NATO this year is much more important than the G7 will be. We know that there's already indications from the NATO Secretary General Stoltenberg that allies will say that Russia is, quote, the most significant and direct threat to NATO security. This is not just Eastern Europe, it's now the entire alliance. Remember, they're bound by Article 5. If one country gets attacked, everyone will have to come to their defense. When it comes to China, to your point, they will now say openly that this is a systemic challenge to NATO. The language around it will be interesting. And then, of course, we always circle back to the perennial debate at NATO, and that is defense spending. What the NATO Secretary General now says, and what a change in tune here, is that the 2% of GDP is not the ceiling. It's going to be something that could be extended way beyond that. It's not the floor, it's the ceiling.
Stoltenberg also talking about the progress over Swedish and Finnish membership. Obviously, Turkey has some reservations about some of this, Maria. Walk me through the potential for this to happen anytime soon.
Well, Erdogan is the start of day one here. All eyes are on the Turkish leader. Of course, he says he has some concerns about Sweden and Finland. He says they don't fight enough counterterrorism and terrorist operations. Now, a lot of the critics say that this is just Erdogan trying, of course, to get concessions and time with the president of the United States. But I have to say today, Jonathan, the mood has really shifted from the morning to now. And there is optimism that a deal to include these two countries to NATO may be on the cards by the end of the summit.
Range of headlines from Stoltenberg, also on China. Disappointed China won't condemn the Russian attack, but they don't regard China as an adversary. Anne-Marie, I want to leave you with the final word here. What would they describe China as?
Well, they're not going to say adversary, but they are going to say that China is strategically a hurdle, if you would. The exact text hasn't been completely defined yet, Jonathan, but they're getting there. A little bit more pressure on China. I would say it's a huge 180 from the last time we got this text from NATO. In 2010, China was not mentioned, but Russia was, and Russia was mentioned as a partner. And part of the reason why they will not go as hard as saying adversary on China is because the country I'm standing in right now, Germany, they have massive, among other European allies, have massive trade with China, economic ties, business ties, and they want to make sure they can balance these two struggles.
The weak link on two big geopolitical issues is Germany seemingly all over again for many people. AMH, wonderful coverage. I know you've got to catch a flight over to Madrid now alongside Maria today. I mean, I just get this sneaky feeling I'm missing out on something this weekend in Madrid with the two of you.
Oh, you are.
Having a very good time. I'm aware. Maria Tadeo.
Never reveal private details, Jonathan, on camera.
I'm not revealing a thing, and neither are you, apparently. Coming up, the Trading Diary. The market-moving events you need to be watching. That'll be next on this programme. With your equity market shaping up as follows. A lift up 1% on the S&P, advancing 40 points, up 0.75% on the NASDAQ from New York City. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Five minutes into the session in New York this morning. Good morning to you. Last week, energy stocks got absolutely hammered. Yesterday, they bounced back and they're climbing aggressively again this morning by 3.5% rather. So far, up 1% on the S&P. On the Nasdaq, up about 0.7% or so. That's the price action. Here's your trading diary. President Biden meeting with the Prime Minister of Spain in Madrid. That's coming up at the top of the hour. Plus, San Francisco Fed President Mary Daly speaking at 12:30 Eastern. Central bankers in focus. Wednesday, the big one. Powell, Lagarde, Bailey, all on one panel in Sintra, Portugal. Plus, a look out for US GDP at 8:30 Eastern. Personal income and spending numbers and US jobless claims coming out on Thursday. And finally, rounding out the week with the big data point of the week. On either side of the Atlantic, you get ISM manufacturing numbers in the US. And over in Europe, you get Eurozone CPI on Friday too. From New York City, that does it from me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we have a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around